From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Stocks down for a second consecutive week last week, and we're adding to those losses this morning, taking some more weight off the S&P. We're negative by 0.75%. On the Nasdaq 100, down by a little more than 1 full percentage point. With 2 hours until the opening bell, let's get you some morning movers and say good morning to Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Yeah, you're right. Look, Mag 7, long duration, all grappling with a full frontal assault from the bond market, and then you have news flow, which compounds on the downside. Apple has just had a quarter they would prefer to forget in terms of iPhone sales, down 5% globally. They're losing market share in a growth market. Why? Because their AI product perhaps isn't as exacting as the market had wanted on iPhone 16. But you got to hand it to Mark Zuckerberg. Not only has he changed the look, the style, and the rhetoric, and really having a pop at everybody and repositioning himself. Steve Jobs invented the iPhone, and now they're just kind of sitting on it after 20 years. I mean, that podcast with Joe Rogan is certainly, there's some moments in that are certainly worth listening to. Roll it over, have a look at Tesla again within the family. There's a bit in an offer story here. On the offer side, you got one of Europe's largest pension funds. It's called Stitching Pension, ABP. They're dumping $500 million worth of stock. Why? Because they've got angst over the pay rise that Elon Musk gave himself. On the bid side, you've got Tesla actually doing better than Audi. Yes, all of them are under pressure. Porsche, maybe I'll get that second-hand Porsche, you never know, drive around the streets of New York. Porsche sales dropping in China, but Tesla is beating Audi. What do you want, a Tesla, an Audi, or a Porsche? Go figure. Let's roll it down and finish off with NVIDIA. The reason why I've pinned this one is a couple of things. One, the story that we put out last week, which was about the new regulation on high-end AI chips, comes into force today. So the official traffic light system comes in. If you're an ally, you're fine. Everybody else has got to get in line. But we're now very firmly in the correction zone. 3 sessions took us down by over 9%. If we open down by another 3%, obviously we're down 12% then. So this is about a stock which has now very firmly entered the correction zone. You're going to hear the clarion call of this is your opportunity. This is your golden opportunity on a correction to jump in. Dan Ives, where's the note? I think it's already out.
Appreciate your time, sir. Thank you. A Porsche. Just to throw that out there. All right, a Porsche. Make it easy. Under surveillance this morning, Apple's core business taking a hit at the end of 2024. Data from Counterpoint Research saying the tech giant sold 5% fewer iPhones globally, with Apple losing market share to Chinese rivals. One reason for the slowdown, Apple AI has been rolling out in stages and isn't yet available in China.
I'm curious how much this has to do with AI availability and sort of a disappointment that it hasn't been more bold or actually more available earlier, how much this is just the national champions in China with cheaper phones actually making inroads, because that is really what you have seen, is essentially huge inroads being made by the likes of Huawei technology and Honor device, basically all Chinese companies. So that, I think, is probably a big part of this as well.
And if you buy some of those national champions and their phones, the actual
actual AI agents they're developing on their own, and they're ready in the phones. You need to wait for this hodgepodge of approach if you buy the Apple phone.
You've got to wait until January 30th to get the official numbers. That's when we get earnings from Apple, and we'll see how they stack up with the numbers coming from Counterpoint Research. That stock is down by a little more than 1%. Elsewhere in Washington, a group of House Republicans saying their meeting with President-elect Donald Trump over the weekend was, quote, positive and productive. The GOP members from New York, New Jersey, California pushing for the $10,000 cap on the SALT tax deduction to be raised or eliminated.
Trump gave them a little bit of work to go back and do, though, basically saying, come back here, according to Mike Lawler of New York, who we actually spoke to last week as well, coming back and basically saying, well, I'm going to need a number. The line is in the sand, though, for these Republicans. I don't think they care so much about if it's one reconciliation package or two, but the fact of the matter is they need SALT included to get their sign-off. And this comes down to the fights that are going to be happening in the next few months when you have the slimmest Republican majority ever. Every single lawmaker on Capitol Hill is going to become king.
Biden had this headache through this administration, Manchin, Sinema in the Senate. Now there's a bunch of them in the House for Donald Trump to deal with.
Which is going to raise a question about how much they can actually cut, given that everybody wants a bone thrown at them, right? It's all the pork.
I was in Palm Beach this weekend. It wasn't just lawmakers from New York, from California that were going down there. You also had all the chairs of the committees from Congress. They are preparing to come in on day one and really already have a lot of these conversations out of the way. One thing I'm really keen to learn about is whether or not the debt ceiling gets put into reconciliation or not. I'm told, and what I'm hearing is that Trump wants it out. He wants these debts cleared as quickly as possible. You have to think, it's debt ceiling, it's spending, then it's reconciliation. It has potential to get messy.
Is that work or vacation? Or a blend of the two?
I think it's bleisure.
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 Yeah.
Because
That's Eric Resnick.
well, I went there for work, but I did also get, you know, some sun on Sunday morning at the Breakers. I think that's bleisure.
Blended.
So
Bleisure.
everyone going to Palm Beach now is just bleisure.
I think, honestly, I think it's everyone. I don't think it's the journalists.
It's leisure.
No, I get that bit.
Yeah, yeah.
Right?
Mark
Thanks for breaking it down for me, though.
Mark Zuckerberg was there Friday evening at Mar-a-Lago hanging out with Trump.
I'll break it down.
Appreciate the explanation.
I'll bring a slideshow.
Yeah, just, I'm keeping up, just about. Let's get you the latest elsewhere, some serious news. The National Weather Service issuing a so-called particularly dangerous situation alert. It's most severe for areas across Los Angeles, including Malibu and the San Fernando Valley. Los Angeles bracing for at least 2 rounds of powerful Santa Ana winds this week alone. A real fear this is going to spread and get worse.
This is devastating. I mean, when you really think about it, people in their homes not sure whether they're going to have to evacuate with go bags ready to get out of there because they might lose their homes and they know it's going to get worse. It is devastating to think. The area looks like it's been firebombed in areas. So you start to wonder, how do you move forward when we still aren't out of the heat of it? No pun intended, a really terrible situation there.
The cost is heading in the wrong direction. AccuWeather increasing its preliminary estimates of total damage and economic loss to a range of $250 to $275 billion as the fires enter their second week. Alex De Silva of AccuWeather joins us now for more. Alex, welcome back to the program. What's the latest?
Yeah, well, right now, the winds are starting to pick up in Southern California, but the good news is some of these fires have been contained a little bit more. The Kenneth Fire and the Hearst Fire are nearly 100% contained this morning. The Eaton Fire is now up to 27% contained, and the Palisades Fire, the biggest fire of them all, is now around 13% contained. Unfortunately, what do we have to look forward to over the next couple of days? More wind coming down into Southern California, big area of high pressure coming down into the Great Basin. This is going to increase the winds, unfortunately, from the northeast here over the next couple of days. We could be looking at 60 to 80 mile per hour winds in those very, very vulnerable areas there, just north of the Los Angeles metro area. This is the area I'm most concerned about. I don't think it's going to be the strength of the last event that we saw, but we could still see wind gusts even up to hurricane force.
Alex, appreciate your time, sir. Alex De Silva there of AccuWeather. Alex, thank you. Let's turn to the economy and think about the impact of all of this. We get some data this week, CPI on Wednesday, PPI before that, retail sales after that. But in a couple of months' time, you're going to see a huge disruption in this economic data. To talk about all of this, joining us now is Michelle Ma of the MasterCard Economics Institute. Michelle, good morning. It's good to see you.
Good to see you. Good to be here.
Great to catch up with you as always. How disruptive will this data be in the months to come off the back of these fires?
Well, of course, I mean, that's probably one of the littlest things that we think about when considering the wildfires right now and the devastation that's having on people and families and livelihoods. But of course, as economists, and we're trying to understand what's happening in the economy and the markets, the high-frequency data matters a lot, and it will be noisy in the coming months. So you're going to see a lot of people trying to X out the impact of California to the extent that that's possible. So a lot of that conversation, without the disruption, it would have been.
It, though, raises some issues, some nodes of pressure that we have, in particular in the housing market. The idea that they're going to have to rebuild at a time where housing shortages already were pretty prevalent in the area. How much room, how much slack is there in the economy to compensate for building, to compensate for some of these things at a time when some people say it's a pretty finely balanced labor market?
Well, of course, I mean, you have to think about the inputs into the equation for rebuilding in terms of the raw materials, the labor, just the capacity to be able to add that much housing stock as quickly as it needs to be added. But that said, we also should be seeing a lot of stimulus into the area, hopefully, which should help encourage and speed up that rebuilding process. But it's going to take time. The devastation is tremendous.
And it still hasn't ended, as we were just talking about. Broadening out, there's a larger question about just where we are and how real the numbers were on Friday, how good they actually were versus maybe overstating things with the preliminary read that wasn't necessarily verified in other data. From what you're seeing, from the MassCard expenditures, from all of the secondary and tertiary data, do you think that this truly is a labor market that has more upside surprise than people are giving it credit for?
I do. I mean, as you know, at the Economics Institute, we've been very positive on the trajectory of the economy this whole cycle. And a lot of that is because of this ability of the consumer to spend, which represents a positive feedback loop with the labor market. So any given jobs number, we know, subject to revision, you have to look at a moving average. You don't want to overemphasize one report. But if you do look at a moving average and you think about what's happened in terms of the last several months, it has still been strong job creation, an unemployment rate that is remaining sticky low, and measures of unemployment insurance, when you look at jobless claims, that are still very, very low. So the labor market is supportive. Wage growth is continuing to run at a solid pace above the underlying pace of inflation for goods and services, and that's supporting consumer spending. As consumers spend, that then further drives this feedback loop back into the labor market. So on Friday's jobs numbers, we had very strong hiring in the retail sector, for example. Part of that was seasonality. November was weaker, December stronger. But nonetheless, that does represent a fact that consumers are engaging.
When it comes to, though, that concern about inflation, I know it's colored with politics, but University of Michigan is showing that actually consumers are concerned about inflation going forward. Is that driven because of talk of tariffs and policy, or is that just driven by they're still not comfortable with the price level they've seen over the course of the past 2 years?
I think expectations are still resetting to that price level, right? When you talk to an average person out there, they're saying, but it used to be so much less expensive to buy this. And that less expensive might have been a week ago, a year ago, or 5 years ago, depending on when they've last purchased the item. So I do think expectations are still resetting. It depends on the product, right? When you think about groceries, for example, over the last year and a half now, we've been in very steady and low inflation, between 1% and 1.5% for grocery inflation. So for food, you're starting to get consumers to feel more comfortable that this is probably the price that is sticking, and it makes sense. They're not continuously seeing price increases. But there is a little bit of a discomfort, of course, amongst consumers after seeing such a big price level increase. That said, if you look at long-run inflation expectations from the University of Michigan, this whole cycle, they've actually been pretty well contained overall. So over the longer term, I think consumers still have a more disinflationary psychology that is sticking.
How do you think the economy will deal with potentially broad-based tariffs of the incoming administration?
So it depends, as you know, how you define broad-based tariffs. So there's so much uncertainty in terms of what the policy will actually end up being, and we'll adapt our views as we learn more. But I think in general, what we've seen in the past with tariffs is that it does prove to be somewhat of a temporary price level increase on those products that are impacted by tariffs. And then it could also just change in general the cost of production, going back to the conversation with Lisa before around the cost of rebuilding and housing construction. Input costs matter in every way, of course, across the economy.
Is it leading to any pull forward from the data you've seen? People buying durable goods, any of that at all?
You know, it's really hard to ascertain whether or not that's happening. You do hear it and see it more visibly in terms of companies stockpiling and trying to make sure that they're importing as much as they can, particularly from areas that might be targeted in terms of tariffs. But for the consumer, that's something that's really hard to determine whether it's a pull forward or it's just an acceleration of spend.
Michelle, appreciate your time as always.
You got it.
Thank you. Thank you very much. Michelle Mather of the MasterCard Economics Institute. On the Federal Reserve front, the last week of Fed speak before the blackout period, you will hear from the New York Fed President John Williams a couple of times this week. Look out for tomorrow, I believe 3:05 p.m. Eastern Time. Very precise for the New York Fed. Some opening remarks.
So have we learned who some or the number
Not yet.
of members? I wonder if anyone's going to stand up and said, I was the one, I was the number, I was the person who decided to take into account some of the potential policies.
Identified one Fed official who might be in the running to become the next Fed chair.
We have.
Who's put themselves in the running.
You're talking about Chris Waller.
Talking about Governor Waller.
Yes,
with that address from last week.
Yeah, it's not inflationary tariffs. Just ignore that completely.
Neil Dutter of Renmac taking that side of things as well. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Already some Fed speak from former Federal Reserve Vice Chair Randall Quarles, who doesn't think that the central bank's independence will be in jeopardy once President-elect Donald Trump takes office.
Structurally, the Fed can't really be affected by the president's bully pulpit. And, you know, the people who are appointed to the Fed generally have fairly thick skins. So while there's certainly political pressure, there's not really political levers that someone can pull to affect their independence.
He also said Trump's planned tariff shouldn't be inflationary, but at the margin could convince the Fed to lower rates. OpenAI's top executives are planning to host events in Washington, D.C. and key swing states to promote investment in AI. The company has released a new economic blueprint for AI, calling for public and private sectors to work together in areas like energy and infrastructure to keep the U.S. ahead of China. OpenAI plans to hold events in Pennsylvania, North Carolina, and Alabama to announce new AI projects as part of its efforts to boost economic activity. The NFL playoffs are in full swing with the wildcard weekend kicking off in a 5-game slate. The Houston Texans upset the LA Chargers after QB Justin Herbert threw 4 interceptions. Buffalo took care of Denver in a dominating 31-7 win. The Steelers fell to the Baltimore Ravens in their 5th straight loss. Green Bay came up short against Philly, and it is jubilation in the Beltway after the Commanders beat the Bucs to win their first playoff game since 2005 behind rookie QB Jaden Daniels. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, turning the page on DEI.
The kind of masculine energy, I think, is good. I think corporate culture was really like trying to get away from it. Having a culture that like celebrates the aggression a bit more has its own merits.
Just for the record, Lisa, far more aggressive than I am. Every single meeting we have.
It's probably true.
The conversation is not next. From New York City, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Things recovering just a little bit. Stocks down by just 0.6% on the S&P. Bond market pretty stable. Crude still rallying. We're up by more than 2% on WTI, but the 10 years hanging in there now, just about unchanged, 476.55. Under surveillance this morning, the focus very much on Meta, turning the page on DEI.
The kind of masculine energy, I think, is good. And obviously, you know, society has plenty of that, but I think corporate culture was really like trying to get away from it. And I do think that there's just something, it's like, I don't know, all these forms of energy are good. And I think having a culture that like celebrates the aggression a bit more has its own merits. It's one thing to say we want to be kind of like welcoming and make a good environment for everyone. And I think it's another to basically say that masculinity is bad.
There's a lot to cover here, so here's some of the latest. Sweeping policy changes at Meta, with the tech giant becoming the latest company to kill its DEI programs, days after overhauling its content moderation. The CEO, Mark Zuckerberg, blasting the Biden administration for putting pressure on its platforms and saying he's optimistic about Donald Trump's return to the White House. Joining us now to discuss is Michael Nathanson of MoffettNathanson. Michael, where do we begin? So let's start here. The advertisers. Mark Zuckerberg is not a leader here, he's a follower, and he is following Elon Musk. What do you think happens next with the advertisers on Meta's platforms?
Okay, good morning, by the way, and thank you for that lead-in. So here's what I think happens. The core of Meta's advertising are small and medium businesses that are buying performance advertising. They're not brand advertisers, right? Brand advertisers get very skittish when they're in content that's not brand safe. Most of Twitter's X's business at the point of the purchase were brands. Brands ran away from that platform. But at Meta, they're there to sell things, to drive traffic. They have very different types of rationales to be there. And I don't think it's going to be that much of a deal for, you know, in terms of changing their reason to be there. They're there for performance marketing, and that's only gotten better through AI the past 3 or 4 years. So it's interesting. There's a lot of noise about what's it going to mean to his core business on the ad side. It's actually probably a non-event, right? It's just a lot of noise, but it's not going to change anything.
Well, Michael, let's build on that. Maybe it won't be bad. Perhaps it could be good. Let's talk about that a little bit more. Engagement. If you strip out liberal influence, if you reduce censorship, do you think that engagement can increase? And can I ask you this as well? Two-part question. Do you think that's what this is really about, or is it just about keeping the incoming administration off his back?
I think he's realized, so let's go to the second question first. I think he's realized, big picture, that he was the only person, the only company really trying to play to the rules that he thought were going to come out of DC. But in that nuance, this is good for Meta, right? He's going to reduce his content moderation cost. To your point, he's going to open up his platform to people who thought it was biased. It's not going to affect his advertising. In terms of your first question about engagement, yeah, it's very possible that you're going to see a subset of consumers actually find more content they like on Meta than they did before. So from a business standpoint, it's a massive win-win. It really is. And then you haven't asked me yet, but if TikTok gets banned, having the administration not consider you an enemy of the people will help if the government decides to challenge or not challenge whatever the Supreme Court decides next week, right? So it's a win-win on all the business quadrants that you would care about.
Let's take that a step further, Michael. Does it increase the chances that Meta could purchase the U.S. business of TikTok?
I can't, at least that is one step too far. That to me would fly in the face of antitrust law, right? But if the government doesn't want to sell TikTok, it means that the winding down TikTok is just a massive win for these guys. But I don't know how a government would allow that to happen. They are their biggest challenger. It's just too big.
Well, the issue is that TikTok is just so expensive. So the individuals that can purchase it, they're all going to be up against antitrust laws. Is there someone, a company, an entity that you think could actually buy TikTok?
You know, Oracle was rumored in the past, right? So maybe Larry Ellison comes in with Oracle and makes a play for it. You could certainly see there's a couple private equity offers to happen. But the reality is, to your point, without Google's ability to buy it or Twitter, maybe X would make a move for it. But Alphabet, Meta can't do it. Perhaps Microsoft would look at it. I mean, it's a really valuable asset, and we'll see if the Chinese are willing to sell it. But to your point, it will not be a frothy auction because two of the biggest competitors will not be allowed to bid for it.
Michael, this is a massive vibe shift taking place in corporate America. And I think it's quite something to see a CEO of one of the biggest companies in this country go on Rogan in the way he did and say the things he did about someone who's still in power, the sitting president. Do you think this kind of behavior from Mark Zuckerberg opens the door for other CEOs to follow and actually start saying what they really think about what's going on in Washington?
To a point, Jonathan, because I think people will be afraid to attack Trump given the fear of retribution for the next 4 years. I think this is a special case because this has been an issue for Meta since 2016. The question about how do you want to moderate content? And they're looking for the government for answers, and the government never came up with a plan. I think this is a specific case because I think it really challenged Mark's personal beliefs about what he should be doing. I don't see it that way. You know, I don't think the next 4 years people will be going out and attacking Trump's policies. Perhaps some will challenge Biden, but I think this is such a unique case and playing to the strengths of Meta and Zuckerberg's, like where he stands right now, right? And also, you have Elon Musk at the hip to Trump, and this is a chance for Zuckerberg to kind of open up some opportunity here to get his thoughts across because it's been dominated by Elon Musk the past 90 days.
Michael, appreciate your time, as always. Watch this space. There's so much to talk about here. Thank you, sir. Michael Nathanson there of MoffettNathanson, the latest on Meta. A lot of positives here in this shift from Mark Zuckerberg, according to the team over at MoffettNathanson. Look, the fear of retribution from the incoming president, I think, has been well covered. There's a whole industry dedicated to covering that story. Haven't covered enough the fear of retribution from the sitting president, Joe Biden, the Democratic Party. Only scratching the surface on that, and we've seen it from Mark Zuckerberg going into the weekend.
Although I wonder, to the point there, Michael's point, is this a specific case, a very specific person?
It's highly unique, let's put it that way. TikTok, I think it opens the door.
I mean, he just basically poured a lot of cold water on that, so I'm not about to sit here and say yes.
From New York City, the third hour of Bloomberg surveillance. Up next.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own three major, have stake in three major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zabe Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Been a rally in bond yields around the world.
The bond market is a little bit on a knife's edge here.
I don't think we want to push our luck on yields much higher from here.
Yields have got to stabilize. Otherwise, you risk triggering these dynamics that can really hurt.
Hopefully we see the sell-off in U.S. rates that we've seen. Hopefully that calms down. I don't think it will.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
So much masculine energy. Overwhelming. Equity futures on the S&P down by 0.7%. On the Nasdaq, we're down by 0.9%. A massive week ahead for you. Kicking off with the economic data, we've got CPI, PPI, retail sales, all of that, and some bank earnings as well. What a busy morning Wednesday's going to be. JP Morgan, Citi, Wells Fargo, Goldman reporting earnings.
Yeah, and that's going to really take center stage in parallel with CPI, which has the potential to edify what we saw on Friday. If you hear the message from banks, consumers are strong, people are spending, the capital markets are open, and regardless of what happens with policy uncertainty, companies are ready to do deals, and you get a hot CPI print, watch out below when it comes to sort of bond prices. Yields will continue to climb.
It's arguably the favorite sector of Wall Street. on the S&P 500 coming into 2025. We'll see if the numbers and the outlook justify it. Throwing this into the mix as well, this move in crude. WTI and Brent. Brent crude up by 1.6 through 81. WTI up by 1.9 through 78. Crude rallying.
Boldest action we've seen yet from the Biden administration in their final weeks, final days in office, really going after Russian crude in a more material way than we've seen during this entire crisis. And then I think you add to that, many people talk about maybe we're going to see a glut in 2025. Then you add to that, what's on the horizon when you think of risk premium? Well, potentially a maximum pressure campaign when it comes to Tehran from President-elect Donald Trump, going back to the playbook that he's likely going to use again. He is going to enforce those sanctions on Russian crude. So that is why you're seeing this tight market.
And that is why you're seeing the equity market pull back as well. This equity market does not fear economic growth. It fears the possibility that we see a re-acceleration of inflation alongside that economic growth.
Especially at a time where a lot of people don't have faith in that economic growth. Let's be honest, how many people trying to poke holes in the data that we got on Friday, talk about the weakness, the stagnancy, the idea that maybe if you get that stronger dollar, it's going to really impede on some of the earnings power, particularly of international companies. So people are more concerned about the risk premia, the idea of something else, deficit concerns, the idea of inflation, these other issues that will cause yields to rise without the commensurate growth.
Quote of the weekend, Peter Chair, you'll like this one. What if markets reacted so poorly because no one believes the data, but everyone believes that the Fed will need to react to the data?
It speaks to the overly data-dependent, data point dependency of the Federal Reserve, and it goes to something we were talking about a lot last week, which is that the Fed might be the ultimate risk factor in the room, because what happened back in 2018 was not the policies of the Trump administration. It was the Fed's reaction to some of these things and the fact that they raised rates, and that, I think, is what a lot of people are going to be focused on.
Look out for the Fed speak through this week, the last week of Fed speak before the quiet period kicks in over the weekend. John Williams of the New York Fed will be speaking a couple of times, kicking off tomorrow afternoon. Equity futures right now in the S&P, just off session lows. We're negative by close to 0.7%. Coming up this hour, we'll catch up with Sam Stovall of CFRA with stocks lower to start the week. Chris Marinak of Jenny Montgomery Scott looking ahead to big bank earnings, and why Veronica Clark of Citi is still expecting 125 basis points of rate cuts this year. We begin this hour with stocks lower, building on the S&P 500's worst day since December's hawkish Fed meeting, as a blowout jobs report puts rate cut bets firmly on hold. Sam Stovall of CFRA seeing trouble ahead. As a result of Friday's hot December jobs report, investors now worry that the number of rate cuts this year may be reduced to only one, if not none. In response, the United States equity markets have resumed their downtrends and are likely to face additional challenges. Sam joins us now for more. Sam, welcome to the show, sir. Let's talk about those additional challenges. Where do those challenges come from?
Good morning, Jonathan. Well, interesting. I was eavesdropping with your conversation with Lisa just a second ago and really trying to figure out what is it that's causing the yields to move higher. And it reminds me of the Chicago song, Does Anybody Really Know What Time It Is? So I think really the question is, how far does the 10-year yield rise? Is it 5%? Is it 5.25%? Or the long-term average of 5.75%? We don't think it'll be going up that high, but I think in the near term, while we wait the PPI tomorrow, CPI on Wednesday, and PCE at the end of the month, all three are expected to show flat to higher readings, and I think that could add to the overall agita.
Sam, 60 minutes ago, we caught up with Chris Harvey of Wells Fargo. Chris made an argument we've heard a few times on this program, that to get lower yields, you need higher yields, that this is self-correcting. We've heard others call it self-limiting. Do you think we're already in that zone where this becomes self-correcting, self-limiting? It puts pressure on the economy, puts pressure on equity markets, risk assets, and yields start to fall back again?
Well, I think it's being self-correcting in terms of the market action itself. I like to take a look at the percentage of the sub-industries in the S&P 1500 that are trading above both their 50 and 200-day moving averages. And right now, we are only at 10%, which is very close to the longer-term oversold level that I like to look at. And so I'm expecting us to see a bit of a bounce back today, as well as possibly early in this week, but probably a retest as we move later in this week and into next week. I think also that investors will be calming down as it relates to the 10-year yield, because I believe that forward inflation readings will reassert the downward trend line. And so I think investors will be able to breathe a sigh of relief once again.
Sam, I want to go back to nobody knows what time it is, because that's sort of what this conversation also is reminding me of. Jurrien Timmer of Fidelity wrote this over the weekend, that earnings growth will ultimately carry the day and push the market higher, but these rate tantrums are a reminder that it doesn't take much to disrupt the market's mojo when valuations are high. You were just talking about the idea of oversold within the index. So which is it? Are valuations high, or are there sectors that are deeply oversold?
The answer is yes. It depends on the timing that you're looking at. In the near term, I think that we could see a counter trend rally because of being oversold. But I believe that we are going to need to see the yield on the 10-year note come back down again in order to maintain the upward trajectory in equity prices, because the valuations are high. Right now, the S&P is trading at a 20% premium to its just 10-year average forward PE ratio, and more than 35% on the 20-year, and technology is close to 65% based on its 20-year. So I think valuations show a market that is priced to perfection, and so I don't think we can see for a longer period of time an elevated level of 10-year yields.
Going forward, do we see banks priced to perfection at a time where we're expecting to see JP Morgan kick off the unofficial earnings season, even though Delta did it on Friday? But I'm just wondering, do you expect that to also prove to be overbought or oversold?
No, I think that the financials are going to be setting a positive tone. Remember that in 60 of the last 62 quarters, actual results have exceeded end-of-quarter estimates, so proving again that management does a very good job of managing expectations. We're looking for a 38% year-on-year rise in diversified bank earnings, looking for 43% gain in consumer finance, and a 45% increase in investment banking and brokerage. So our belief is that we're likely to be pleased quite a bit from the start of the earnings reporting period from financials in general and from the banks in particular.
I wanted to ask you and go back to that idea of the 10-year yield heading lower. You say once things start to calm down when it comes to jobs and inflation. But when you look at what's going to happen now in Washington, there's a debt ceiling debate. They still have to deal with 2025 fiscal spending before March, before they even get to this idea of reconciliation. Why do you think the 10-year yield will be calm during all of that?
Good morning, Anne-Marie. Well, I think that I wouldn't necessarily say calm, but I do believe that it will probably look to reassert its downward trend, mainly because I think that we are going to be seeing a decline in GDP growth from the 2.8% that we forecast for 2024 down to a 2.5% level for 25 and a 2.2 level in 2026. Certainly, there are a lot of what-ifs that are out there that could work against this, in terms of the tariffs being more than a negotiating ploy, elevating the SALT write-offs and what kind of an impact that would have on government revenues, et cetera. So there are a lot of things out there that I think are going to be adding to volatility overall and lead to a single-digit gain in the stock market for all of 2025. But I don't think that we're headed for a deep correction or a new bear market.
Well, I was in Palm Beach over the weekend, and it's not just Lisa now talking about this concern of a Liz Truss moment. Do you think that the bond market is going to have a seat at the table when it comes to policy in Washington?
Good question. I think that certainly that Washington, they ran on the platform of cutting expenses, reducing the overall debt level, et cetera. So I think that the electorate will be reminding those at the table that that's what they ran on, that's what they won for, and now that's what they have to carry through.
Sam Stovall of CFRA. Sam, appreciate your time, sir. Thank you very much.
Jonathan.
Looking ahead to a massive week with tons of economic data and bank earnings as well. I agree with Anne-Marie. It's an important question. Will this bond market get a seat at the table down in Washington, D.C. when they come together with their big number for tax cuts?
I guess it depends on what this bond market is saying and whether it's actually whipped itself up into enough of a frenzy to actually get some attention from Washington, D.C. That is sort of what people seem to tell us. It's sort of like, yeah, it depends.
It is getting attention. Over the weekend, Senator Vance, soon to be vice president, mentioned bond yields twice as his interview at Fox News, and the concern that you bring up all the time. So I don't know why you're shaking your head about paying off the interest payment on our debt. 1 to 1.5 trillion, 2025. Maya McGinnis is saying it's going to be more than 1 trillion again this year.
Because they've mentioned it, but it doesn't have a seat at the table because it doesn't have a corrective mechanism. But you're right, people are mentioning it.
Can we just reduce the masculine energy around the table just a little bit? It's overwhelming me. It's absolutely
So
overwhelming.
sorry. Good morning, John.
Oh, boy.
Let's get you an update on stories
Happy
elsewhere
New
this
Year.
morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Residents and firefighters in Southern California are bracing for at least 2 rounds of vicious dry Santa Ana winds early this week. The powerful gusts are expected to challenge crews struggling to contain 2 blazes, which have left at least 24 people dead and destroyed over 12,000 buildings. JP Morgan CEO Jamie Dimon says that if used properly, tariffs can help resolve issues of unfair competition and national security. In an interview with CBC Sunday morning, he went on to say, like any tool, if it's misused, it can do damage too. President-elect Donald Trump has promised to add new tariff levies on imports from China, Canada, and Mexico when he takes office next week. Dimon said that he has not spoken with Trump about tariffs. Johnson & Johnson announced that it will buy Intra-Cellular Therapies, a biopharmaceutical company focused on the treatment of nervous system disorders. J&J will acquire all outstanding shares for $132 per share. That is a total equity value of $14.6 billion. The transaction is expected to close later this year and is subject to regulatory and stockholder approval. And that's your brief, John.
Danny, thank you. I don't think we can overstate this, just how much the incoming president has changed the conversation around tariffs. I used to go on radio with Tom years ago and talk about tariffs and why we needed tariffs because China wasn't playing by the rules and that you needed reciprocity, and people in the room would look at me like I was a heretic. And now you see people like Jamie Dimon coming out on the record talking about the need for them in certain places and why.
Yeah, and the idea of them being targeted. And frankly, we saw Joe Biden keep a lot of them on and actually increase certain ones of them. So it is a bipartisan type of effort.
Well, that's what I was going to say. This is now bipartisan policy in Washington when it comes to tariffs, especially on your adversaries like China.
And just on the margin, getting an endorsement from a key player on Wall Street as well. Up next on the program, the Morning Calls Plus, we'll catch up with Chris Marinac of Jenny Montgomery Scott. We're looking ahead to some big bank earnings, including JP Morgan. That all kicks off on Wednesday. We'll get his thoughts in just a moment. From New York, good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
about 14 minutes away from the opening bell. Equity futures pulling back by 0.6%. The Nasdaq's down by 1 full percentage point. Similar move on a Russell. The small caps lower by 1%. In the bond market, check out Treasuries first, and then we can get to the gilt market. The 10-year Treasury yield just about unchanged now. So there's some good news, some comfort for the equity bulls just on the margin. 476.55, and some comfort if you've been following the sell-off in the UK government bond market as well. Gilt yields just a little bit higher by 4 basis points at the front end, up only a single basis point on a 10-year. So Keir Starmer, the British Prime Minister, 100% confident the UK will get economic growth that we need. We'll be ruthless in our spending decisions, and the Chancellor's doing a fantastic job and has his full confidence.
Yeah, Rachel Reeves is completely safe in her position. She is the Chancellor for good reason, because she is the right person to do this job. This is according to the Cabinet Office Minister, Pat McFadden. I will just say, bond market right now is not impressed.
Not impressed, and has been pushing back.
Yes, I always think that's more diplomatic.
Over the past few weeks. Let's get you some morning calls. First up, Bank of America raising its price target on Delta Airlines to 78, highlighting its pricing power and positive industry backdrop and all of Lisa's spending. The stock is down by about 1% this morning. Your second call from JP Morgan, downgrading Constellation Brands to neutral, flagging a deterioration in consumer demand for alcohol. That stock's softer by 0.66%. And finally, Stifel raising its price target on Alphabet to 225, expecting a boost in ad dollars if the Supreme Court upholds the US TikTok ban. That stock is down about 0.7%. Let's turn to the financials. Big bank earnings kicking off on Wednesday. JP Morgan, Goldman, Citi, Wells Fargo all reporting. Christopher Marinac of Jenny Montgomery Scott writing, fundamentally banks are well positioned for success as businesses and stocks in 2025. Chris joins us now for more. Chris, welcome to the program, sir. What is there to be optimistic, to be positive about for the year ahead for the financials?
So I think lower interest rates are really the key. The Fed's dropped 100 basis points, and that is a huge for how the cost of funds resets both in fourth quarter and first quarter. Obviously, the Treasury rates are backed up the last 10 days, but I think we can work through that. Overall, pricing is still very favorable for banks, which is going to allow the net interest margins to rally both in the quarter reported this week and next week, as well as what the outlook's going to be for the first half of the year. So that combined with loan growth accelerating from the Fed data in the months of November, December is very positive for the sector at this point.
Chris, we'll talk about where some of the revenue growth will come from, the tailwinds and the drivers in just a moment. Can we just sort of touch on expense management? We've all seen a lot of headlines, reports, including from us here at Bloomberg, about how strong bonus season's going to be for certain banks. Will you be focused on expense management, and where will that show up in certain places, certain banks?
Sure. So I think the bonuses will be part of the fourth quarter number, and I think to some extent you will see a higher accrual for 2025, but that also goes over to higher revenue growth. So I don't think it's an issue per se, but I'm absolutely focused on expense management. We've had a lot of companies tell us that if revenue growth goes up, that they will adjust expenses a little higher, not just for bonuses, but also just for increased spend. There are a lot of banks trying to compete with each other to grab additional personnel, particularly at the mid-sized banks, to win additional lenders and to find additional avenues for growth. That's going to lead to more spending, but I also think it's going to be matched by the expanded margin and net interest income growth that we think is happening right now.
What kind of spending do you want to see? And I'm talking in particular about artificial intelligence at a time where there are a whole host of estimates, including Brian Moynihan of Bank of America, coming out and telling us that he expects the size of business to grow dramatically, but the staff to maybe stay the same because of some of the augmented resources. How much are you examining which banks are best positioned for that?
So I think every bank is trying to get more efficient along the way, Lisa, but I also think that from the standpoint of AI, what you really can do as a bank is use AI to be thoughtful about your regulatory compliance. You know, every bank still stumbles on AML and BSA rules to some extent. We had a recent issue with B of A on that front. I think the AI can really help on that area. To some extent, the cyber world is continuing to be the biggest area where banks spend, so AI gets lumped into that. But I also think to some extent you can also make the customer experience better. And a lot of the commercial-oriented banks who have small and medium-sized businesses continue to sort of sharpen their pencil as it pertains to improving the experience to do more business with the same customers.
These are all the things that banks have some control over, at least in the near term. There are a lot of things that they don't have control over, and that has to do with policy coming down the pike. And that's been one of the main drivers for some of the optimism around mergers and acquisitions, some of the potential deal-making that really gave way to some of the optimism behind the bank trade. How much visibility do you expect to get from executives on that front?
Well, I think there's a lot of optimism about policy improving banks, particularly on sort of where the capital rules are going to go, getting mergers approved faster, as well as just the overall grinding of the regulatory community, which was very difficult in 23 and 24. That, I think, easing up as this year and next year plays out is a huge positive for banks. I just think that's going to allow them to be more on their front foot and really be more aggressive and assertive with trying to expand their business, which includes deals. So all of that policy change is out there for us to sort of take and accept. I think it's going to take us 6 to 9 months to really filter through, but I do think it's out there and it is positive in terms of where it's heading.
At the same time, you started this conversation, Chris, talking about how lower rates were actually beneficial for banks, and certainly lower front-end rates are beneficial, especially with higher longer-term rates if they can lend long and borrow short. But there is this question about what that does to the deal-making environment. At what point it becomes a real downside, a real headwind to potential deal-making and some of this optimism that we've heard about. Where is sort of that line in the sand for you?
So I think seeing the Treasury rates go above 5% would be one line in the sand. I think if we get the 5 and 10 year above 5, that's a huge red signal. You know, loan marks and fair value marks on deals are still an issue, even coming off of what's transpired the last 2 years. And we are removed from the liquidity scare, but we still have the interest rate mark scare as it pertains to higher rates. So 5% is, I think, an important line. I also think to some extent it would harm the stocks, and therefore the stocks filter down into less enthusiasm for deals. So stock prices have a role in this as well.
Hey, Chris, appreciate your take. Looking ahead to the big bank earnings later this week, Chris Marinac of Janney Montgomery Scott. Lisa, to your point, I think it's an important one. Spent a lot of time in 24 talking about surviving until 2025. Survive until 25. And a story being that you get close to 25, you get bailed out by the Federal Reserve. If you held on, they'd start cutting interest rates. That story's changed pretty quickly to kick off the new year.
And there still is this feeling that maybe companies adapt and adjust and they can keep going forward, and they've actually pushed out the maturities so much that it isn't going to be a problem. That said, some of the hope that's baked into some of these bank stocks, that there are going to be huge deal-making opportunities, that there's going to be huge issuance, that maybe even IPOs could come back, does that make sense if you have rates that are punitive or prohibitive and that are actually just forcing companies to stay alive rather than really engage in big expansions?
But I think the deregulation is something everyone is just welcoming, because what did the JetBlue CEO say to us? It can't get worse than this. And they view this now as an opportunity to potentially go into the market when they were waiting on the sidelines because of how this administration was running their regulation.
You didn't know what kind of deal could get done. You really didn't. And I know we've reflected on this before, but I go back to the conversation we had with Brian Moynihan at Bank of America, Lisa, together maybe 9-10 months ago, when Brian turned around and basically told us very early on, there are companies that can't even have a conversation about doing a deal that would probably like to do a deal because they don't know what kind of deal can get closed in Washington.
And it does seem like there will be more deals that will be acceptable to getting done, and certainly they're prepared. I just wonder about the financing at a time where you've got yields at such high levels and whether they have the cash on board. But pretty much by all accounts, everyone's saying there will be a lot more deal making.
There must be a pipeline of deals ready to go from the last 2 years.
Yeah, well, we've heard that, right? I mean, we've heard that from Jane Fraser. It's going to be like it's just basically a hose of deals. Again, where exactly are the deals going to happen, and where is the pushback going to happen? I'm very curious to see who takes over the FTC. I'm very curious to see exactly who gets through this nomination process. It's going to be taking place in Washington, D.C. I mean, there's still a lot of unknowns, and so that's the reason why the price to perfection comes into place. Or is it sort of understated optimism because they always sandbag us ahead of the earnings?
It's some of that and some of that. And a little bit of that. On Wednesday, massive morning on Wednesday morning for you. So at 8:30 Eastern time, we'll get CPI. That's the big data point of the morning. We'll also get numbers from JP Morgan, from Citi, from Goldman and Wells Fargo. And once we've got through Wednesday morning, it's on to Thursday, where you get Bank of America and Morgan Stanley and some retail sales data as well. So that 48, 24-hour period is going to be massive for markets.
It's your favorite time of the year when you actually get a lot of interesting details about the borrowers and the corporate environment ahead. Why are you laughing at me?
Because you know I hate bank earnings.
I never thought that you hate bank earnings.
And she's ditching us for it.
A fire hose of numbers
that are so instructive.
Pre-market that no one really looks at until later in the day.
And then they parse through them and come up with a story.
Drives me nuts.
It'll be fun.
our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The opening bout 60 minutes away. Equity futures on the S&P 500 negative by 0.7%. On the Nasdaq, near session lows down by close to 1%, and a similar move on a Russell on a small caps. With your morning movers, let's cross over to Manus Cranny. Hey, Manus.
Jonathan, good morning. A brutal moment for Moderna. This is a brutal reduction in their demand outlook. They said they're going to make $1.5 to $2.5 billion in sales. That originally was $2.5 to $3 billion. This is a $1 billion drop in terms of the estimates. Add into that losing market share. It's the beginning of the JP Morgan Healthcare Conference, so you're going to see a ramp up in information here. They're losing market share down to around 40% in the COVID vaccine market, down from around 48%. So the stock is under huge pressure, as you can see, and counting. There will be further cost cuts, but the cost cut story is not translating at the moment. Now, when it comes to deals, back in the game, J&J bidding $14.6 billion for this company, Intra-Cellular Therapeutics. Think about schizophrenia, think about depression. These are central nervous systems disorders. This is where there's a hole in the rundown, as it were, for J&J. They want to step in there. The stock is roaring higher. This is a cash bid. It's the largest biotech transaction in over a year. J&J stock, it goes meh, but certainly the specter of this helping the stock. Let's just round it off with Apple. It's a holiday season for them. They probably would prefer to forget. Overall, iPhone sales dropping by 5% globally. They're losing market share in China. They don't have the AI features perhaps that everybody wanted. But you got to hand it to Mark Zuckerberg for the killer line. Steve Jobs invented the iPhone, and now they're just kind of sitting there 20 years later. That is a brutal assessment, coming from somebody, as Danny said this morning, that went out and bought everything rather than invented a great deal of new product in his own company.
Manus Cranny, thank you, sir. Fascinating podcast with Joe Rogan. I encourage everyone to take a listen to that when you get the chance. Apple was trading at a pretty lofty multiple. So when they come out with earnings at the end of this month, this is not a good time to be missing estimates at all.
Especially at a time where there's ramping up of geopolitical tensions and just the ability to have a place in China, given Tim Cook used to be the chief diplomat, but now does that even matter if you have national champions?
Zuckerberg's trying his best to be a diplomat as well.
Is he?
Yeah,
is that what this
the incoming
is?
administration.
Well, yeah, he was.
Without a doubt.
He was. I don't know if he was beleaguering, but he was also in Palm Beach Friday night once again. I think this was his second dinner with President-elect Trump.
It's a different kind of diplomacy than we're accustomed to. I think that was sort of my point, because a diplomatic approach to things typically isn't necessarily that.
It's diplomatic. You're saying diplomacy is generally
diplomatic.
Diplomatic.
Right. But this is diplomacy of a different sort.
Got it. Thanks for clarifying. When did you go on vacation? On Wednesday. Skiing. Nice. Let's turn to the economy. Almost there, Bramo. Investors bracing for PPI and CPI data this week, with the December payrolls report prompted widespread rate cut doubts. Veronica Clark and the team over at Citi still looking for several cuts this year, writing, "It may now take several months for Fed officials to see reason to resume rate cuts. Our base case is for the next rate cut to occur in May, with 5 total 25 basis point rate cuts this year. Veronica joins us now for more. Veronica, good morning.
Good morning. Thank you for having me.
Let's get into it. Let's get to the jobs report first, and we'll work our way through it. So you were at the low end, looking for 120.
Yes.
We got a massive blowout.
Yes.
So what did you and the team miss, and how are you looking at things now?
Yeah, it is some remarkable stability. I think even more important than that payroll jobs number, which of course was really big, was we saw the unemployment rate declining, and that's really where we're taking more of our trustworthy signals from. And it does look now like a couple of months where the unemployment rate is stable in this 4 to 4.2% kind of range. I think the issue for us is that just looks like a very precarious stability because we do know that hiring is so low. If that's the case, I don't see how you don't just have some gradual upward pressure on the unemployment rate. New labor market entrants, if you do happen to lose your job, you're not finding one very quickly. But yeah, this has been a couple months of stability and might just take a bit longer for the Fed to see any more weakness. So.
Is it enough to make you question your own process, you and the team? How many more months of this would get you there?
Yeah, of course. I think I would want to see hiring pick up to know if this is a real stability or not. I think the last couple months, we had the unemployment rate moving sideways, but for a couple months there, it was alongside people dropping out of the labor force. That's not a stable situation. I think you would want to see hiring picking up, but yeah, maybe this time is different. Obviously, we have had some pretty remarkable data.
How policy dependent is this for you, given the fact that a lot of people are saying companies are waiting to figure out what the policies are?
Right, yeah, there has been a lot of uncertainty, obviously new administration. I don't think that uncertainty has really improved within the last month or two. So I think we would maybe be waiting still another couple months to know. In general, I do think a lot of the resilience of the economy the last couple years has been because we have had such substantial fiscal support. And that already is going to be fading for 2025. And now, obviously, if rates are restrictive and that's weighing on demand, well, 10-year yields are higher than when the Fed started cutting. There's a lot, I think, of policy restraint that's going to weigh on the economy.
What makes you believe that rates are restrictive?
Yeah, because we've seen labor demand weakening. We certainly see that in the very rate-sensitive sectors, housing, manufacturing. We still were losing manufacturing jobs even in last week's data. And we see hiring weak, and that seems to be not just a normalization of the last couple of years of really tight labor markets and strong hiring, but it does seem to be businesses are looking to cut labor costs, and maybe that's to offset high borrowing costs. That's what restrictive rates do, and we see that in survey data, anecdotes in the Fed's beige book, and so I don't really see that picture changing.
Going back to policy, how tight can the labor market get if we do see these deportations the president-elect is talking about?
Yeah, it's going to be an interesting question, and certainly that will affect a lot of sectors. I do think over the last couple of years, substantial immigration has probably helped to loosen the labor market. It's helped to slow wages. So the reversal of that would be probably net inflationary, see upward pressure on wages again. But maybe precisely because it would impact certain sectors so much, we are not expecting big deportations.
But when you look at potentially what would that mean for the unemployment rate?
Yeah.
Do you see a tighter labor market, then would you have to reassess how you view the labor market?
Certainly you could. I think there's obviously a timing issue. We don't really know if we are going to get these deportations. If they do happen, it's probably not really impacting activity until later in the year. I think at the earliest, you do have to legislate some of these policies first. But yeah, certainly that could be a game changer. I think the issue is that's not necessarily in the next 6 months.
Deportations, and that word is highly charged and aggressively debated. You can park that and still have a conversation about labour supply. We've seen millions of people come across this border, the southern border, illegally, undocumented workers. If you're able to reduce some of that, and we've seen all of that start to be reduced over the last several months as this administration went into an election and heads towards the exit. What kind of change are we going to see off the back of that?
Yeah, that's definitely been a factor the last couple of years, and already that new net immigration is slowing. I think the issue for the data is it's really not been captured well in the data. So I don't think that's the reason the unemployment rate has risen, for instance. That household survey just doesn't capture new immigration very well. Maybe it was one reason for running stronger for payroll job growth, and you can see that slow. Of course, we didn't see that on Friday.
A lot of people watching this program from outside of financial markets. If we can get wages up, that's good news, not bad news. That's fantastic news.
Right.
Is there any reason to believe it's stagflationary?
Yeah.
Because that would be bad news.
Right, absolutely. And some, potential policy changes certainly could be look stagflationary at least. Deportations is one of those. You can get the upward pressure on wages, but you're going to see some bad economic data if you're deporting a bunch of people. That's going to weigh on activity. So there are those risks. But I think for this labor market, we do see wages slowing. You see that in the employment cost index, the Atlanta Fed's wage tracker, and that makes sense with an unemployment rate that has risen. This is a looser labor market than a year and a half ago.
So just quickly, CPI, PPI this week, you're confident we're still on this disinflationary trend?
Yeah, I think so. I think a lot of the inflation data still look weird. A lot of the components are not quite normal, but we are starting to see finally things like shelter inflation slowing, and that's been a really sticky, strong component for a while. It could probably look pretty volatile, but the trend looks more favorable there. So yeah, even if you get some surprises in certain components, this does look like inflation that's slowing for now.
Veronica, it's good to see you.
Thank you.
As always, thank you. Veronica Clark of Citi, still looking for 125 basis points of cuts this year, where the market's getting closer and closer to zero. Mike McKee, our economics and policy correspondent, joins us now for more. Michael McKee, a ton of data this week and a sprinkle of Fed speak as well. What are you focused on?
Well, obviously, we're focused on CPI, John, because that's going to be the major number of the week. It's going to be the number that moves markets that are already very nervous about inflation. We get PPI tomorrow. PPI is expected to rise significantly on a year-over-year basis, and that could scare some people. Maybe the creak in the floorboards before the guy from one of those horror movies shows up. And that could be on Wednesday when we get CPI, and CPI is expected to rise to 2.9%. On a core basis, 3.3%, and that's not what you want to see. We have so far seen inflation as measured by the CPI bottom out in September, and it's been moving up every month since towards 3%, and you got to wonder, when do the markets get really scared? And I don't mean just pushing up rates, but when do they start thinking about the Fed actually raising interest rates to fight inflation? I'll leave you with this thought, John. What's the 2-year note yield right now?
4.40.
You know what the Fed funds rate is?
Around 4%.
4.33. So at this point, the 2-year note, for the first time since the Fed was raising interest rates, is now above the Fed funds rate, and that basically suggests people are starting to think about the idea of rate hikes.
Mike McKee, getting closer, that's for sure. Appreciate your time. Adam Posen, the first out of the gate, suggesting that could be a reality. And I have to give Adam Posen repeated credit for this. He was talking about this back in August, before we got that Jackson Hole speech from Chairman Powell.
And it's now become an increasing conversation with Bank of America piling on and basically saying there is this increasing risk the next move is a hike. You just wonder at what point that is what's really factoring on some of the sell-off that we're seeing in the equity market.
I thought we were about to do a pop quiz with Mike McKee then.
Oh,
it's on the edge of my seat. Where's the S&P?
Yeah, exactly.
Brent Studi of Northwestern Mutual joins us now. Brent, coming into this year, the average forecast on the S&P was about 6,600. We've had a strong data point, a sell-off in bonds, and the bears started to come out. Can you give us the reasons to be confident, optimistic, if there are any left for 2025, please?
Well, I guess I'm more towards the cautious side, not the optimistic side, and that doesn't mean that you should obviously sell all your equities. But I think the conversation that you're having is a real one. We have higher interest rates. I think the hope was the Fed would be able to cut rates, and that would alleviate pressure on parts of the economy that have been harmed by interest rates. Think about housing, think about manufacturing, but that is not what is occurring. And you did see a strong jobs report last week, but you also saw inflationary pressures. The ISM services prices paid spiked at 64. I don't think anybody talked about this too much, but the University of Michigan 5 to 10 inflation expectations rose to 3.3%, and you actually saw some sort of return to inflationary psychology where people were buying in advance. And so we kind of have this odd thing going forward where we have to worry about what does the Fed do next. And the reality is higher interest rates are here to stay, and that means they continue to work their way into the economy. That means asset prices have to reflect those, and that's where I think there's valuations right now that don't make sense with the 10-year Treasury around 475.
Where do you find those valuations, Brent, in certain sectors, certain groups of stocks across the S&P? Where's that more concentrated, that risk?
I think the concentration is more in the S&P 500, where the risk of high valuations is certainly out there. Look, the S&P posted its second 20% plus gain, but it was narrow again. If you look, less than 30% of the stocks actually beat the S&P 500, which is the second time in a row. So it did it in 2023 and 2024. To find similar numbers like that, you have to go back to 1998, 1999, which scares me just a bit. And then before that, 1980 and 1973. The thing that ties all those together is that it was a later cycle economy where the economy had become more bifurcated, and that's led to bifurcated markets. We think there ironically are opportunities on the other side. The market tends to broaden after that. Now, whether or not we have to have a recession to kind of cleanse that is up for grabs, but we're positioned more for the broadening because that's where valuations are cheap, even though I know higher rates harm those parts of the economies like small caps, mid caps, the equal-weighted S&P 500. I do think one way or the other, there is a broadening on the other side, and since we're intermediate-term investors, that's where we're focused.
So are you just basically hoarding cash right now, waiting for that to happen, for there to be some sort of blow-off in the top, and then head into that sort of broadening out trade?
No, I mean, we're not hoarding cash by any means. We stay fully invested, but certainly we're more positioned with a tilt towards those areas. We do still invest in bonds, and we think that you should invest along the curve. I mean, even at 475, that's an attractive yield. It does reflect some worries of inflation that are out there. I think one way or the other, the Fed will get this under control. It just may take a little bit of tightening in between. And so that's where we're just a bit more cautious right now towards the overall equity markets.
Someone who is bullish on the equity markets might say, what do they need to get under control? What this is an economy that's managing just fine with 4.25% rates, benchmark rates, and that basically you have this engine of innovation and some of the big tech names that continue to deliver at this transformative time. Why is that not convincing you?
Is that already priced in? That's the first question I would ask at the earnings multiples that we're paying for that. The second question is, does the Fed want to get inflation back to 2% or not? We have not been at 2% yet. And people always say, well, isn't it close enough? Look, I don't know. That's the kind of psychology that existed in the 60s that led to higher inflation. And that's where I just believe they're going to have to try to get it back under control. And those numbers that I mentioned last week, the University of Michigan 5 to 10 year is something the Fed's pointed to. And that's a real thing. If inflation psychology changes, that could be kind of making inflation more embedded from what it's been in the past, which is kind of just more of a temporary thing, I think, or a transitory thing, dare I say that, more tied to COVID. I think it's now becoming more embedded where people are expecting it longer term.
T-word was banned a long time ago. Brent, you know the rules. Brent Shitty of Northwestern Mutual.
Monday morning, I forgot.
Brent, appreciate your time, sir. Thank you, buddy. Thank you very much. Certainly the mood has changed on the FOMC. You've seen that in the official communication we've had from a handful of members over the past week, showing some discomfort with inflation.
Discomfort with inflation. I think that the increasing question becomes, how low is the bar for them to start talking about the possibility that they'd have to hike again? It's one thing to not hike for the remainder of the year, but that's another step to actually become more restrictive.
And how much tension is that going to cause with the incoming administration when you have a president-elect that wants rates lower? This is a real estate guy that wants to see rates lower. He doesn't want to see the Fed hiking.
Wants rates down, wants the dollar weaker, and has some policies that might push things in the other direction.
Which will lead to the Mar-a-Lago Accord, and Mark McCormick is volunteering his services as head of Canada.
He's not the first to say that yet, you know.
I know, well, that's what it might lead to.
I think all it takes is that you just get some finance ministers together and just start saying a couple of things, and you see things shift the other way pretty quickly.
Yeah, but what would that deal look like? I'll give you this factory.
I don't know.
And then you give me this.
Who wants to play ball if you're going so aggressive on tariffs is another question as well.
Maybe Greenland.
We'll see. Greenland? Okay, that's a conversation for another day. A long conversation, an important one at that as well. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The wildfires in Southern California have killed at least 24 people and destroyed more than 12,000 buildings. Over the weekend, firefighters got a brief break from the dry Santa Ana winds that have spread the flames across nearly 38,000 acres. However, another round of wind gusts is expected to pick up later today. The National Weather Service issued a rare, particularly dangerous situation red flag warning for parts of Ventura and Los Angeles counties from early Tuesday morning until noon on Wednesday. Tesla has beaten Audi in global car sales for the first time, even though Tesla sold fewer vehicles than expected. The VW-owned car maker suffered a 12% slump in total vehicle sales, hit by competition in both Europe and China. Audi's EVs declined also, dropping 8% to around 164,000. Venture Global is seeking up to $2.3 billion in its IPO. The second largest U.S. producer of liquefied natural gas plans to sell 50 million shares in a prelim range of $40 to $46. It plans to float on the New York Stock Exchange. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, setting you up for the week ahead. You're watching Bloomberg Surveillance.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I Go.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
$40 minutes away from the opening bell and recovering just a touch. We're off session lows on the S&P. Still negative, though, by 0.6%, down by 0.9 on the Nasdaq and down 1 full percentage point on the Russell. In the bond market, a shape of the curve for you, 2-year, 10-year, 30-year. The 2-year just about unchanged, around 440. Lisa at 438.77.
Yeah, to me, this is a real question. At what point do we start talking about the potential for some sort of increase in rates by the Federal Reserve at a time where this market's all but pricing out rate cuts entirely for the remainder of this year?
Deutsche Bank, Matt Lazzetti, he said it early on. Now you've got Aditya Bhatt and the team over at Bank of America saying the same thing to kick off this week, looking for no rate cuts in 2025 from the Federal Reserve. And this won't help. Crude, Brent, WTI rallying today. Brent crude went through 81 earlier on, $80.90. Amory up by 1.4%. WTI up by 78, up by 1.9. This is not just about the economic data. It's not just about growth. This is about policy down in Washington.
This is about sanctions, the boldest, most significant we've seen yet on Russian companies, on the vessels that carry Russian crude, going after two large oil producers, Gazprom Neft and Surgut Nefti Gas. Maybe never heard of it, but it is certainly impacting. One analyst put it at 800,000 barrels of potentially that's going to be impacted from this. And the critics are saying, why is the Biden administration doing it now? They are leaving. They are heading towards the exit. And you'd have to think they're doing it now because gas prices for the domestic consumer are no longer their problem.
Talk about poisoning the well on the way out the door. That's pretty shocking stuff.
And given the fact that potentially the incoming Trump administration, if they were going to do a deal with Putin, I imagine Putin is going to want sanctions relief, part of any deal he does with Ukraine, with the U.S. potentially negotiating that. To get these sanctions lifted, you cannot just go to the Treasury Department. What one analyst was saying, who really needled through all of the language, they have to go to Congress and get congressional votes to lift these sanctions. What's going to happen with some of those hawks in Congress that say, no, I want to keep Russian crude off the market?
This feeds into some of the fears that I think market participants have right now. It's not just about strong jobs numbers. Inflation expectations picked up in New Mitch on Friday. Now, you can sit here and say that is a ridiculous number influenced by politics, and I would sit here and I would agree with you. But I'd pick up on that argument from Peter Sheeran Academy. There is just a worry that the Fed will respond to that. The Fed has responded to you, Mitch, before. It's responded to these things many times in the past.
And just to take it a step further, it just increases the temperature that much more for Wednesday's CPI print, because if you get a hot CPI print on top of expectations increasing, it'll be a lot harder to ignore.
Elisa mentioned CPI. Before we get there, tomorrow, PPI and Fed speak from John Williams of the New York Fed. I think that is going to be a really, really important one. If he offers any color whatsoever on his expectations for interest rates, bear in mind, there's a handful of officials in the FOMC right now who are uncomfortable with inflation. There was one governor in the past week that didn't seem too uncomfortable, and that was Governor Waller. Fed President John Williams is part of the big trio. The vice chair, the Federal Reserve chair, and then you've got the New York Fed president. What he says on this issue will carry a lot of weight to this market before we get to Wednesday, when we get CPI and big bank earnings kicking off with JP Morgan, Citi, Goldman, and Wells Fargo. On Thursday, more earnings from Bank of America and Morgan Stanley, plus retail sales and another round of jobless claims. We'll also be keeping a close eye on Los Angeles, with the city bracing for Santa Ana winds to pick up again this week. Just for a brief note and an update on what's happening over there, we can catch up with Zareen Shah, joining us from Altadena. Zareen, give us the latest, please.
And the anchors just Matt or Matt and Shanali for this?
Yeah, the latest is that the death toll is 24 people. The missing count, 16. One of my own neighbors is one of them. His family does not know where he is. And right now, a lot of people are just really fearful that their community could be next. The winds are expected to pick up again. You know, we're here in Altadena, where I know 3 people who have lost their homes, and they're incredibly afraid of not just the next coming days, but just the future, but how they're ever going to insure their homes again, and what the rebuilding process will be like. So a lot of stages of grief and emotions here.
Zareen, appreciate the update, and no doubt you'll be giving us updates throughout today on Bloomberg TV and on Bloomberg Radio. Things set to get worse and not better. There's a real fear of that in the coming days.
It's horrendous, and people are trying to be very delicate as they fight a fire that is still very much a threat, still at some of the more severe threats, while also looking forward to the rebuilding effort and just how to recover. It's a really horrific situation.
We'll bring you updates throughout the day, of course, right here on Bloomberg. Coming up tomorrow, we'll be hitting the ground running, catching up with Stuart Kaiser of Citi, Emily Rowland of John Hancock, Libby Cantrell of PIMCO, and Venu Krishna of Barclays as we await some economic data. PPI tomorrow, CPI on Wednesday, retail sales on Thursday, and tons of bank earnings coming up on Wednesday and Thursday. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
In case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
All right, another down day, 30 minutes until the start of the cash trade here in the U.S. I'm Matt Miller.
I'm Sonali Bassett. Katie Greifeld is on assignment today, and Bloomberg Open Interest starts right now.
Coming up, LA fires still raging as Santa Ana winds are poised to intensify the wildfire battle. We'll take you to the front lines. And stock traders have been rattled, hit by diminishing bets on Fed rate cuts as Apple's iPhone sales fall 5% in the holiday quarter. Plus, it's merger Monday. J&J agrees to buy Intracellular Therapies for over $14 billion. Katie Greifeld is in the midst of all of that pharma action at the J.P. Morgan Healthcare Conference in San Francisco. She's going to bring us interviews with the CEOs of Eli Lilly, Teva, and GSK. Let's take a look right now where the markets are trading. It is a down day in terms of futures. S&P futures off 0.7% on continued concerns about fewer Fed rate cuts than previously we would have expected. We closed on Friday at lower than we opened on November 6th, the day after the Trump election. So all of those gains have been wasted away. The 10-year yield is one of the main problems. We are 52 basis points higher than we were on November 6th. When you look at the 10-year yield, 4.77, the fear is 5%, and it is approaching rapidly. NYMEX crude oil is one that a lot of people may not have had on their bingo cards as much higher post-Donald Trump. It's $6 more than it was on the morning of November 6th at $77.79, and Brent crude over $78 a barrel. One of the biggest moves that we've seen post-election is in the dollar. This is the Bloomberg Dollar Index. I have a 5-year look just so you can see that we're getting closer and closer to the peak that we saw in 2022. This was on a Fed rate cycle. We're now in a Fed cut cycle. And yet, the Bloomberg Dollar Index is stronger than it's been in more than 2 years, Sonali.
That 10-year was almost touching 4.8% this morning. I almost shook you but I figured I'd let you wake up. It's only Monday, right? After all. Anyway, some stocks we're also watching. We're looking at a lot of retailers here today. There's been a lot of news. Macy's gave a downbeat outlook for sales in the current quarter after holiday spending failed to deliver at the country's largest department store. You do see Macy's down now 1.7% pre-market, but Lululemon is on the rise, up 2% or more pre-market. Sales for the current quarter beats Wall Street's expectations despite a consumer spending slowdown. Abercrombie & Fitch, it raised its sales outlook, but the increase was not enough to reassure investors of fast growth. Abercrombie now down more than 9.4% pre-market, but of course we know that's been a high-flying stock, Matt. A lot of dispersion, though, right now in the trade when you look at across sectors.
All right, so it feels like generally the tone is very somber when it comes to markets. The blowout jobs number that we had on Friday, adding, I think, 256,000 jobs, really drove a lot of bets on the Fed not only no longer cutting, but some banks thinking they may even raise now in this year as inflation becomes a real worry. We have PPI coming out, I believe, on Tuesday, and CPI coming out on Wednesday. We're looking at 3% plus jumps on both of those, especially if you look at the core number year over year. I think 3.8% is the expectation for producer prices. So a lot to talk about today. And Shonali, you sent a note from Ed Yardeni explaining that he thinks, you know, it could get worse here, but maybe a buying opportunity.
Yeah, I think this is fascinating. He said that some of the pullbacks that we've been seeing could turn into corrections of more than 10%, but less than 20% this coming week if Tuesday's CPI inflation rate for December is higher than expected. Investors more and more worried here about that 5% level on the 10-year. Stuart Kaiser over at Citigroup sees an S&P move 1% of either way, depending on how CPI behaves. Of course, we have PPI before that. Let's see where it all goes. At the end of the day, you seriously do have a risk-off attitude underpinning the markets at the very least, all just ahead of bank earnings starting earnings season.
Yeah, and these big mega cap stocks are down. I'm looking at NVIDIA right now, trading off 3.6% in the pre-market. Let's bring in Bloomberg's Danny Berger. She anchors the brief for us, and she's been watching these big mega cap stocks lose ground this year.
I have to say, just looking at that Yardeni quote, I mean, of course, Max Kettner is also out with a note saying that this is an opportunity because they went in so bullish this year.
Dan Ives also has been bullish and says this is a buying opportunity.
Correct. Dan Ives out with a note saying, tech might sell off, but it's going to be okay. That's part of the problem, right? And part of why we've seen this vicious reaction is that sentiment was maybe overstretched. Valuations were high. So you get a data that comes in that sells yields higher. It's very clear where the reaction has been. It's been in rate sensitive, the mega cap stocks that are already long duration type stocks, and small caps where you have a lot of floating rate debt. Now, in terms of whether or not it lasts, the bulls, as it were, point to the idea of why rates are going higher. If it's because of good economic data, because the labor market is strong, then earnings will be good and these stocks will come back. If it is because of inflation, if oil becomes more of a story, then maybe it's not so good, and maybe that's a reason you could have an enduring sell-off.
You know, you look at the sell-off, you have NVIDIA now looking at erasing its year-to-date gains, and that would bring most of the Mag 7 this year so far early in the year, but it would bring it in the red. All of them are negative on the year. So what does that mean in terms of expectations for earnings and what these companies have to show? We just reported, Danny, that NVIDIA is looking at tie-ups with more health companies, for example, to expand its product base. Clearly, the market's not yet really biting on these, frankly, marginal announcements that are coming out from these companies.
Yeah, it's not only that one. It's also CES, NVIDIA saying we're going to get into robotics and we're going to get into autos. The market took that as a disappointment. And again, it comes back to this idea of just how much we've rallied at this point. You need to come out with something big. With NVIDIA, it's about the hyperscalers continuing to spend. I mean, you mentioned Apple. What a bad time to see sales that look like they dropped about 5% in China year over year. A time where you have valuations that are stretched. A time when you're worried about trade tensions. It is a bad cocktail of things. And when rates are where they are, if they're getting near the danger zone of 5% and valuations are high, you need to put out stellar performances and more exciting announcements, I guess, in the case of NVIDIA, to actually excite investors.
Apple now down more than 5% this year, extending declines even this morning after that latest iPhone news. And frankly, Apple, Amazon are also consumer stocks, Matt. So that's another place where the rubber hits the road.
Right. Well, I mean, hopefully, as Danny pointed out, you know, a stronger labor market can mean good things for their earnings. In terms of the NVIDIA story, that they're going to have tie-ups with the Mayo Clinic and Illumina, I mean, who wouldn't have expected those companies to be using AI anyway? I will just say as a footnote, Katie Greifeld out at the JP Morgan Healthcare Conference is going to interview the CEO of Illumina tomorrow, so I'm sure we'll get more on this media announcement.
Danny, thank you so much for joining us. Of course, now we're going to turn now to Bank of America's head of U.S. small and mid-cap strategy, Jill Carey-Hall, another person to talk about this higher for longer rate environment with here. Jill, when you think about 5% on the 10-year, small caps, mid caps, it's where investors get the most worried. What's the read-through?
Thanks for having me. Yeah, I think the latest payrolls report on Friday underscores our caution on small caps. We think mid caps are an area within the SMID universe that offer better risk reward as we head into 2025 now. And I think the fact that our economists are now expecting no more Fed cuts this year, they expect the Fed to remain on hold after what we saw on Friday, that causes refinancing risk for small caps to be a risk that reemerges. This could be a pretty significant hit to operating earnings over the next 5 years. Small caps have a lot more short-term and floating rate debt. They have a lot more debt that's coming due over the next 5 years. They're also more sensitive to long rates. So as the 10-year Treasury yield has continued to rise, this becomes a bigger risk for smaller companies. They're longer duration. A lot of these companies also are non-profitable. So this is all at a time where, as we're heading into earnings season, small caps have still struggled to emerge from their profits recession. Analysts are still expecting negative year-over-year earnings growth for small caps. And, this has been a big disappointment relative to a year ago. Analysts had been expecting a much bigger recovery for small cap earnings.
Jill, where is the best place to buy small and mid cap stocks? I mean, we hear about, you mentioned the unprofitable scenarios here. I think 40% maybe of the Russell 2000 is unprofitable. I wonder how that looks on the S&P 400. Are there certain industry groups on those two indexes where you see more profitability and less reliance on, necessary refinancing?
That's right. Yeah, about 35% of companies in the Russell 2000 are non-profitable, and this is stayed elevated. We've had two recent earnings recessions, COVID and the one over the past year or so. We've also had after the IPO boom in 2020, 2021, more and more non-profitable stocks get added to the index, biotech, small cap software, some of these areas. So within small caps, the S&P 600 is a higher quality index than the Russell 2000. And then, we do think tilting up the cap spectrum toward mid caps, mid caps have seen better fundamental trends, better revision trends. They have less refinancing risk, less leverage than small caps do. We also think they have less policy risk post-election if we are to see tariffs and immigration reform relative to small caps and the potential earnings hit they could face. So we do like mid caps over small. We also think this is going to be a year where you want to focus on stock selection over just buying indices. Obviously, post-election policies and many of the themes that are going on would suggest that stocks and subsectors could react differently. We're still seeing high valuation dispersion, so lots of both cheap and expensive stocks within the market. So we focus on economically sensitive stocks that have low balance sheet and refinancing risk. We still think CapEx spending by corporates will pick up, so stocks that can benefit from that, but don't have a lot of leverage will benefit. Stocks that are just seeing positive revisions rather than negative revisions have held up well. And then from a sector perspective, we think financials looks attractive. It's screened well in our work. Obviously large cap banks, could see some of the biggest benefit, but even within small and mid caps, this sector ranks relatively well in our work.
Jill, just one moment here, because we do have some breaking news from the information now that is sending NVIDIA shares a little lower. They were already lower by more than 3% this morning, now lower by more than 4%, extending declines because, according to the information, customers are cutting NVIDIA Blackwell GB200 racks orders. Those customers include some of their largest customers, Matt, including Microsoft, AWS, Google, and Meta. So sky-high expectations really
all of the other Mag 7 stocks cutting their orders within with NVIDIA. That is headline. I mean, look, the stock was already down, what, 3.8, 3.9% at its lowest levels of the session, not being helped by the news or the press release that Illumina and the Mayo Clinic are going to be using AI. Of course they are. But this is a problem. If big customers like Microsoft, AWS, Google, and Meta are all cutting orders on the Blackwell chips, or at least the GB200 racks, this according to the information, we haven't independently verified that, it's not great news for NVIDIA. Okay, so the biggest caps in the world, from the small caps to the big caps. Jill, thanks so much for joining us. Jill Carey-Hall there, B of A, head of U.S. small and mid cap strategy. We got to get you back on a day when it's not the big stocks making the news. Coming up, crews battling the LA wildfires face a new threat this week with more Santa Ana winds expected. We'll head to Altadena, California next. This is Bloomberg. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
Now, residents and firefighters in Southern California are bracing for at least 2 more vicious rounds of dry winds early this week. The powerful gusts are expected to challenge crews struggling to contain 2 destructive blazes, which have left at least 24 people dead and destroyed over 12,000 buildings. AccuWeather has raised its estimate for wildfire damages and economic losses to between $250 billion to $275 billion, and that's up from $135 billion to $150 billion. Bloomberg Intelligence anticipates the Palisades fire will likely be the highest insured fire loss ever. The problem here, Matt, is that you are looking at a fire here at which the insurance losses will only cover a very small percentage at the end of the day, really, of what will actually be damaged. More than 12,000 structures.
Yeah, I mean, so it's I think TBD what exactly officials mean by structures. That could be also a shed in your backyard or a carport. But it is for sure that a lot of these homes aren't covered by insurance. There is a program in place that may not be terribly solvent, the FAIR program in California, that should cover up to $3 million in losses. But of course, many of these homes are $5–6 million
We're
houses.
already going to have to look at raising more money for that fund. We're going to go now to ABC's Zoreen Shah. She is in the Altadena fire zone. Zoreen, tell us what you're seeing on the ground.
Yeah, I can tell you that, but just to bounce off what you were just talking about, the California FAIR Plan, that's actually the insurance I have. I can talk to you about it quite a bit. It's from the state. I lost my home in this fire. We were thankfully insured, but there are a lot of questions about this insurance. Will they be able to pay everyone out? Will they be able to pay everyone out the max amount? And how on earth is this insurance going to continue to last when so many homes are just completely decimated? But in terms of where we are right now, we are in Altadena. This entire area, I mean, it looks like a war zone. I have 3 friends who have lost their homes in this area. And they are just in incredible grief and disbelief right now. A lot of them did not have the type of insurance they probably would have had they known their house was going to burn to the ground. The winds are expected to be incredibly intense today as well, up to 75 miles per hour in some parts of Southern California. Forecasters are issuing a rare warning called a PDS, or a particularly dangerous situation. And we are not in the clear at all. There's a lot of homes still threatened, and this is a very scary scenario for a lot of people.
So, Zoreen, where do you go? You know, your friends who've lost their houses, the tens of thousands of people who are stranded now. I imagine there are hotel rooms for some, or you can sleep on a friend's couch for others, but what's the longer-term solution to people who aren't going to get back into their homes for not just months, but possibly years?
Yeah, it's a good question. I mean, look, insurance does, if people have fire insurance, it will cover a lot of that for, yes, up to 2 years. But right now, a lot of these folks, they're staying at friends' homes, they're staying at hotels, and they're just waiting to sort of figure out their next steps. But people who do have fire insurance, like the Woolsey fire that happened a few years ago, I've been in touch with a lot of people from that fire trying to figure out how they navigated. They do say that fire insurance will cover a lot of time in a hotel or another home.
All right, Zoreen, thanks very much. Zoreen Shah there covering the fires for ABC. Really appreciate your time, and very sorry for the losses that you're all looking at in this tragic fire. I want to go from that. It feels wrong, but I'm going to go from that back to the markets. Of course, that's what we cover here. And they're not looking that great either this morning. S&P futures are down only 0.7%. But keep in mind that we closed on Friday at a lower level than we opened up on November 6th. So all of the Trump bump that we saw since the election is now gone from this market. NASDAQ futures down even more than 1%, as we see NVIDIA falling more than 4% on the news from the information that Meta, as well as AWS, Google, and Microsoft are all pulling orders for the GB200 racks that hold the Blackwell chips. Russell 2000 futures down just as much as well as we see rates rise. Chanel, you pointed out earlier that, you know, we saw the 10-year get to almost 4.8%. It was, I think, 4.79 and change at one point, and we're not far off from that now. So these rates continue to scare investors.
It's also very volatile. You look at it, we're right below 4.7% right now, but just this morning, hours ago, we were touching that almost 4.8% level. You have to wonder if investors, more and more, you're seeing 5%, 5%, 5% in every note. Investors are preparing for 5%. Are they preparing for 5.5%? I mean, what's the upper bound? When no one's willing to call it, then how difficult is it to invest in this environment?
Yeah, I mean, couple that with the fact that oil is a lot stronger than many people would have expected, with Brent up over $80 a barrel now. We're just knocking on that door, I think 77 and change with West Texas Intermediate. And then you've got the strength of the dollar. Mike Wilson out this morning with a note saying that although on the whole, you know, the S&P only gets about 30% or less of its revenue from international buyers, there are some companies that are really pointed in that direction. When you think of the hardware, technology hardware makers, for example, when you think of household goods makers, for example, food and beverage stocks, for example, getting a lot of their revenue from overseas. And when the dollar rises like this, it's been a huge jump since the election. problematic, to say the least.
You know, I think a lot of investors take a while to realize the rest of the world's problems become our own. You think about that just with Apple, for example, and when you think about the weaknesses in China, it impacts one of the biggest stocks that we're looking at here in the Magnificent Seven. Now, I think we really have to start asking the question, if you do have inflation expectations rising, yields riding higher, is the consumer going to cause a dent in this equity market story too?
Yeah, absolutely. We'll get that inflation data tomorrow and Wednesday. We're going to come back with more on these moving markets. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
To the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Let's get now to high interest, a look at what's making headlines around the world. Ceasefire talks between Israel and Hamas are making progress. Israeli officials told Bloomberg they've presented a detailed outline in a second day of indirect discussions in Qatar and are awaiting approval. Incoming U.S. Vice President J.D. Vance says a deal to release hostages held by Hamas could be struck before President-elect Donald Trump returns to the White House, and he did promise that would be the case. President-elect Donald Trump met with House Republicans from New York, California, and New Jersey over the weekend. On the agenda, state and local tax deductions, or SALT. The representatives from those high-tax states felt support and said the talks were positive, but Trump made no firm commitments at this meeting. But remember, when he was on Long Island, he promised he was going to get rid of the SALT cap that he put in place in 2017. And a significant milestone for Tesla as the EV maker overtakes Audi in global car sales for the first time. That's even though the company sold fewer vehicles than expected. Audi, which is owned by Volkswagen, saw annual sales slump 12% due to intensifying competition in Europe and China.
I check on futures here, of course, because we are looking at a really down day in markets here. We're looking at S&P that is down 0.8% before the market opens. Futures for the NASDAQ down more than 1%. Same for the Russell 2000. Stick with us. We're less than 4 minutes from the opening bell. We are going to talk about what's causing the sell-off. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on-site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Matt Miller. Futures are lower and continue to get worse as we approach the open. Now down 0.8% on the S&P. NASDAQ futures down 1.2% as NVIDIA falls more than 4% in the pre-market. Russell futures down 1%. Here, the opening bell on the New York Stock Exchange. Citi is celebrating Martin Luther King Day, or honoring Martin Luther King Day 1 week early. Of course, on Martin Luther King Day next week, we're going to have a couple of events like the inauguration and, more importantly, the National Football Championship for college. On the NASDAQ, you see what says NASDAQ Entrepreneurial Center. I'm pretty sure those guys are from Invesco, because NASDAQ and Invesco have put together a biotech IPO, and so they're ringing the bell today. In terms of the stocks that we're watching today, Apple is one of them. Remember, we told you that iPhone sales fell 5% in the last quarter. Not a huge surprise, but just a reminder that it's an issue, and Apple's shares are some of the worst performers of the Mag 7. I think Shanali said they're the worst performers this year. You're looking at the live indexes there, but here's Apple down 2%. You see some of the other Mag 7 stocks taking a leg even lower today. NVIDIA, obviously, is the big one, down more than 4% after the information came out with a report that Microsoft, AWS, Google, and Meta are all pulling orders for the Blackwell chips, at least for the racks, the GB200 racks. Here, NVIDIA down 3.7%. And when a $3.5 trillion stock loses 3.5%, that's guaranteed to weigh on the indexes on which it's listed. Shanali, what are you watching?
Well, it's incredible. The Mag 7, only 2 stocks in the green still. Let's see if that holds today. There are some other areas of green, but really a lot of red on the screen. Macy's down another 3% as the market opens. It trimmed its sales outlook after the holidays had failed to deliver for investors. Remember, there were high hopes, now down more than 3.3%. Abercrombie down another 9% as well. Lululemon is up on the day so far. They're bullish on sales for the current quarter. Abercrombie's getting some negative sentiment even after raising its guidance, down almost 9%. Really interested here, Matt, to see what's going to happen with CPI and what happens to these consumer stocks later this week. Flip up the board also here. I want to also talk about Johnson & Johnson. Mega deal here that we're looking at. Intracellular therapies up now 35% as the market opens. J&J is going to be buying them for $14 billion. That's a 39% premium to Intracellular's closing price on Friday. We're going to now bring in Katie Greifeld. She's at the J.P. Morgan Health Conference in San Francisco. Hey, Katie, what a morning to start with a bang here, a mega deal in the healthcare space. What does it mean for J&J, and is everyone talking about it?
Yeah, there is a ton of news out already. Of course, J&J
kicking us off with a bang. Bloomberg reported this news yesterday. The company's confirmed it this morning. So let's go through some of the details here. Like you mentioned, largest biotech deal in over a year. So $14.6 billion is the price tag. That works out to about $132 per share. And some information on Intracellular. So this is a company that focuses on central nervous system disorders. Think mental health and neurological conditions. The reaction from the sell side has been pretty positive so far. You have a note out from Mizuho saying that this is obviously a great outcome for Intracellular there. It was interesting to see Johnson & Johnson a little bit higher as well. And their read of that is that basically it's tough to criticize J&J here for the price tag. This is a revenue-generating asset in an area that this company knows very well. So J&J clearly going on the offense when it comes to deal making. Remember, they bought Shockwave back in April as well. J&J is not alone, you guys. Just think in the past 24 hours, we heard that GSK is going to buy drug cancer firm IDRx for up to $1.15 billion. You have Biogen out with a takeover deal for Sage. And just in the last hour or so, we learned that Eli Lilly is going to buy Scorpion Therapeutics' breast cancer program for up to $2.5 billion. So, Shonali, you in particular know well, there is a lot of optimism over deal making right now. We're going to try to break more of that news over the next 2 days.
Well, and you're going to be talking to some of these CEOs, right, Katie? I mean, Lilly, we're going to hear your interview with Dave Ricks in just about an hour or less. And I think tomorrow you're talking to the CEO of Illumina, which at least announced some sort of cooperation with NVIDIA, one more of the thousands of companies that's going to be using NVIDIA's chips in an AI push.
Yeah, you're right. I know NVIDIA shares not looking too pretty today, but of course, this is good news for Illumina. I think Mayo Clinic also involved in that. But you're right, this is a bit of a rip up the script moment. We are speaking, of course, to Dave Ricks at 10 a.m. Eastern. That'll be really interesting. It's a nice reminder that they do more than just weight loss drugs. We'll also be speaking to GSK's CEO, Emma Walmsley, later on today, of course, about their news in the oncology space and the deal making they're doing there as well. And just in a couple of minutes, we'll be talking to the CEO of Teva as well. So a lot to look forward to.
All right, Katie, thanks very much. We'll talk to you in just a moment. Katie Greifeld there at the JP Morgan Healthcare Conference out in San Francisco. Right now, I'm going to turn back to markets that are falling. Nimrit Kang joins us, North Star Asset Management Chief Investment Officer. Nimrit, it's really, the rise in yields that especially the move that we saw after the non-farm payrolls number came out on Friday, that's putting a damper on this rally, really erasing all of the gains that we've seen since the presidential election. Does this continue? Do we see stocks headed down further?
Matt, it's a rough way to start the year, but not entirely unexpected. So every year on average, we see a 14 to 15% intra-year declines, and yet the equity markets are positive 75% of the time. So, we came in pretty hot and heavy into the year, and there's still a lot of uncertainty. We don't know what the policies are going to look like on taxes, tariffs, immigration, lot to work through. But we think it's a regular intra-year decline that we're seeing in the market here. So nothing that would get us off of being too worried here.
What do you do with the big cap tech stocks here? Because you're looking at every single Magnificent Seven starting the year actually in the red, except for Meta, barring Meta. Meta is actually today the only one in the green. Do you load up on these opportunities at a time where investor after investor has been saying it's time to broaden out the trade?
Shonali, the reason Mag 7 has outperformed to the extent is because their earnings are outpacing everything else. That's the reality that we're contending with. The AI boom is real. Even if you look at the hyperscalers, which are the part of the Mag 7, they're spending something like $200 billion a year in those investments. So that thesis still very much remains intact. Now, if you have missed that rally, maybe now it's a time to, dollar cost average into some of those positions. positions. We own a couple of the Mag 7 names. We've held them for long periods of time. So we're not getting shaken out of our conviction there. We're doing the work. If they get sold off even more, we think that the long-term fundamental trends are very much intact. So we would take these opportunities to add to those exposures.
In terms of what to expect from the Fed, Nimrod, and how much it matters, what's your outlook? I mean, everybody had been pricing in continued cuts this year. Now there are some, Bank of America, saying it's possible that the Fed raises rates this year. What do you see, and how much does it matter to your investment case?
Well, we've been yo-yoing all over the place with the Fed actions. You know, we started off 2024 expecting 6 rate cuts. We got 3, right? And the 10-year, even if you look back to 2024, went all the way from 3.7 to 4.7. Again, all these data-dependent scares that come up to the market. So we think that, yes, anywhere between 4.25 to 5 is a fair value for a 10-year yield. There is a secular long-term pressure upwards on the yields because of the aging demographics. So we've been taking our time to add exposure there as the yields back up. But overall, the Fed remains very data dependent. We've got good prints that's put Fed on pause. You know, that's not to say that down the road, this is so early in the year, we might get some other prints that are not that compelling, and we might have the rate cuts back again on the table again. Not to mention that we still do not have a lot of certainty and visibility on the policies of this incoming administration at this time.
I also want to take note of the VIX at this moment because we are at a 21 handle that is slightly elevated. The 1-year average is about 15. So we are above that for sure. If you think about the data points we have ahead, we have PPI, we have CPI, and investors are still keeping a close eye on inflation here. Do you wait for some of those critical moments to pass before you put on some of these larger trades, given that clearly the market is expecting some more volatility?
Yeah. The background is of higher volatility. Within that, picking exact days is very difficult. So the best way to do is just dollar cost average. You know, we're going to get some of these prints. Some of those are forecast wrong. We know that. And with that assumption, we're just going to kind of, bite the bullet there and we just leg into our positions as we move forward.
Nimrod, great to get your take today. Thanks so much for joining us. Nimrod Kang there of North Star Asset Management. Coming up, we're going to head back to Katie in San Francisco, where she's sitting down with the CEO of Teva Pharmaceuticals, Richard Francis, on a down day in the markets. Also happening now, U.S. National Security Advisor Jake Sullivan is speaking with Bloomberg's Jenny Leonard as the Biden administration enters its final week in office. This is part of our Newsmaker series, and you can listen to the conversation by typing Live Go on your terminal. This is Bloomberg.
Your overarching approach on China, as you mentioned, has been to responsibly manage the relationship so that competition doesn't veer into conflict. Over the last 4 years, but also more recently, we've seen major hacks of
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Let's head out to Katie Greifeld in San Francisco. She is at the JP Morgan Healthcare Conference, and she's got the CEO of Teva. Katie?
All right, thank you, Matt. I am here with Teva Pharmaceuticals CEO Richard Francis joining me right now. Nice to see you in person.
Great to be here, Katie. Thanks for having me.
So let's talk about the past year that you've had, because you take a look at your share performance, shares up 111% last year alone. That is your second best performance on record. How do you plan to keep that momentum going in 2025?
Well, so thank you. Thank you for having us, and thank you for recognizing that. And maybe could I just take a moment to bask in the fact that the team have achieved that. And I'm really proud of the team at Teva, because we've had some tough times, and to come back with that share growth happens because we've done a lot of things well. And I think it's primarily been driven by the fact that we've moved our innovative portfolio forward, and we've sold that particularly well and commercialized it really well in the United States. Austedo, Uzedy, and Ajovy. And those have performed tremendously well. We've raised our consensus twice in the year because of their performance. And then towards the end of the year, our pipeline started to mature, and we saw some great data on our TL1A. And that was sort of, I think really surprised everybody. And so with all that, we had a great 24. And in a way, to be a little bit boring, it's going to be more of the same in 25. We're going to keep driving Austedo, keep driving Uzedy, keep driving Ajovy, and bring that pipeline through. Because now people are really excited about the innovative aspects of Teva and our pipeline. We'll still do that. And on our generics and biosimilars, keep driving that. That's been a consistent driver for us and throwing off cash that allows us to invest in that innovative business, which is creating so much excitement.
Well, in your case, more of the same is good. I'm sure your shareholders would be happy to see a repeat performance there. But I want to talk a little bit about generic drugs, and particularly prices, because prices for generics still going down in the U.S. And I believe you said on your latest earnings call that you expect generic prices to be pushed down further in 2025. So against that backdrop, I mean, how do you sustain the generics business in that deflationary environment?
Well, I think for generics, you've got to have a few things. You've got to be global in scale, and we are. You've got to have a really deep pipeline, which we do, great manufacturing capability, which we do, and then a go-to-market model, which we have that global reach. But we have to do all of those three things really consistently. I do think, there comes a point where as much as we can offset those price decreases and keep growing the company, I do think healthcare systems in the United States and Europe need to understand, are they paying the right amount for what are high-quality medicines? I think Teva supplies roughly 1 in 10, 1 in 12 scripts in the United States. So every 10 or 12 scripts is a Teva script. And I'm very proud of that because we help, affordable medicines, people have access to affordable medicines. But despite our efficiency and our scale, then I do think potentially we have to really think about that if we want to have that level of service and not to have any issues with supply.
Well, let's get into some supply questions here. I want to talk about Adderall, because you have both brand name and generic Adderall in a shortage since 2022, which of course you manufacture. What more can be done to end the shortage, and what role do you think that the government and other companies should be playing here?
Yeah, I think this is an interesting one because there's been a sort of dramatic increase in the prescriptions of this product. And so because of the type of product it is, we're given a quota by the government for what we can make. And so we make that amount and we max out on that amount because it's a restricted substance. And so it's quite a complex supply chain. I think part of it is about assessing, is this about supply or is this about prescriptions and is this about over-prescribing? And I think that's the area that needs to be looked at, but we're maxed out on what we're being asked to do and we're committed to do that. So I think it's a bigger, more complex story.
Two questions there, I guess. Would you expect that, that ceiling on what you can make to move higher? And then what is your opinion? Do you think that this is an issue of supply or over-prescription?
That's a really good question. I mean, I think it's one where, when I look at it comparative to other markets, then the usage and the supply is a lot higher in the United States. So we don't often see discrepancies on a geographical scale like that. So I think it's probably something that, as people investigate it, and I think the government should look into it, and the FDA, I think it maybe is a bit of both. But I think the supply is probably where it should be, maybe needs a bit more. I think the prescriptions has really accelerated dramatically, and we've got to ask why. Is that a change in the incidence, the epidemiology? I'm not so sure.
Yeah, that's a big question when it comes to overprescribing that I won't ask you that particularly, but I do want to talk about GLP-1s because you came out with your first generic GLP-1 drug. It's a copy of one of Novo Nordisk's lineup. What are your plans for selling generics of the more popular GLP-1s that are out there?
So we plan to do it. So we have that one, Victoza, that came out last year, and this year we plan to launch Saxenda, so it's another GLP-1. And our aim is to, as a global generics company, any product that loses its patent, we sort of have in our line of sight. And obviously the bigger ones, we definitely have in our line of sight. So all those GLP-1s and those emerging other modalities in obesity, we would target. But we always think about capital allocation, because as much as we're a $9 billion generics business, we're also one of the fastest growing innovative companies. And so capital allocation is very important. And so we're still putting the majority of our capital into our innovative business because we have such a deep pipeline and such an exciting pipeline that we want to make sure that's properly resourced.
Well, to that point of capital allocation, let's talk about the M&A outlook here, because we're at the JP Morgan Healthcare Conference. We are being hit over the head with deal announcements, and you're expected to see a more friendly regulatory environment, at least in the United States, under the second Trump administration. What is your strategy when it comes to M&A right now?
Yeah, so we're sort of, our balance sheet allows us to do a certain amount, so I don't think you're going to see us go big. We're probably going to in-license a lot of, look to in-license products. But the thing we have is, because we have this pipeline that I keep talking about, late stage, we have a product, Dari in asthma in phase 3. We have olanzapine in phase 3 for schizophrenia, and we have the TL1A, which everybody's excited about at the end of last year in phase 2, now moving to phase 3. So we have a lot of growth drivers coming forward in Teva. So, and then we have other products that we've moved into phase 2, Emrisolmin for MSA, a rare disease. So we have quite a lot on our pipeline. So when we think about BD or M&A, we've got to think carefully because we can allocate a lot of capital to our own pipeline and I think give a good return for our shareholders. And so when we look outside, we just got to be mindful, is it worth bringing that in or do we have a pipeline? And that's a challenge we always have in our industry. But I think we're in a particular privileged position with Teva because of the pipeline we have. But we'll aim to do some more in licensing than big M&A.
All right, well, that's a good place to leave it. Richard, really appreciate you taking the time.
Thanks, Katie. Pleasure to be here.
All right, back to you, New York.
Katie, thanks very much. Katie Greifeld there, and she'll continue to interview CEOs from the JP Morgan Healthcare Conference in San Francisco. I have breaking news on U.S. Steel. The stock is jumping after a report that Cleveland-Cliffs is partnering with Nucor to make a bid for the company. All of those stocks in the green, but notably U.S. Steel up the most, now trading up 8% at $37 a share. Shonali, this was a stock that had traded over the last year, at one point, more than $42 a share, when there was more optimism that Nippon Steel from Japan would come in to buy it. It became a huge issue during the election. Both Kamala and Donald Trump saying no way are they going to let a Japanese company come in and buy U.S. steel.
And of course, the Biden administration finally putting the nail in the coffin on that deal. But you have now CNBC reporting that what this would look like is an offer in the high $30 a share. That's certainly where now you have the stock trading just under 37 bucks. And to your point, this was a stock that in 2023 was almost 50 bucks. So you could call it a steal. Nucor, according to the report, would be buying the Big River Steel subsidiary. So then Cleveland-Cliffs would take the rest. Remember, Cleveland-Cliffs earlier in the process did try to make an offer here and get involved. And you could tell now that if he does, he will be doing it at quite the steal.
All right. Yeah. Interesting story. I like that.
Didn't do that one on purpose.
Not intended. Yeah. So we'll continue to follow U.S. Steel for you and the potential of an American buyer, white knight, if you will. We'll continue to follow these markets for you, which are down at the S&P 500, currently off 0.7%. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's time now for the Wall Street Beat. Today we are looking at bank earnings to come this week because they are going to come in hot and heavy starting Wednesday morning. JP Morgan, Citigroup, Wells Fargo, and Goldman Sachs. And then Thursday we have Morgan Stanley and Bank of America. And a few things here, Matt. When we look at the way that the financials have performed, it is often those bread and butter investment banks with the return of deals that have been doing so well. Morgan Stanley, JP Morgan, Goldman, and Citi in particular. But you do have a bit in some of the regional banks as well. And in fact, very few of the regional banks in the KBW Bank Index have been underperforming. You take a look, for example, at First Horizon, up 22% just over the past 3 months alone. You have the same for others, like Zion's, up 7%. So you're not seeing it outpace the S&P, but still there's hope there.
Yeah, I have questions as to especially some of the regional banks on the West Coast. How exposed are they to this fire damage that we're seeing? And then, going back to the big ones, Goldman Sachs putting together a new unit that we're going to talk about later on in the program.
Yeah, this capital solutions business, of course, that's a recognition that right now companies are looking for money from everywhere. That includes the private markets. Going to be a big part of that comeback story. Now, coming up in the next hour, we're going to speak with Eli Lilly CEO, joining Katie to discuss the obesity drug shortage, health insurance, and more. Stick with us for that conversation from JP Morgan.
offers before to take over Greyhound, but then in the midst of the pandemic, 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The Southern California wildfires, one of the most destructive natural disasters in the state's history, are still raging in and around Los Angeles. At least 24 people have died. More than 12,000 structures have been destroyed or damaged. Avanti Prasanna grew up in the Pacific Palisades.
What I always thought was one of the most beautiful neighborhoods in Los Angeles is just gone.
Despite a lull over the weekend, more powerful winds are on the way. KNX's Craig Figner is in Pasadena.
It's a chance for Southern California firefighters to gain the upper hand on two major fire scenes. The Pacific Palisades fire, which has burned more than 23,000 acres, and the Eaton fire, more than 14,000 acres, that one in Pasadena and Altadena. The next windstorm could be 72 hours starting Tuesday.
Schools in Los Angeles are reopening today, but as the fires continue to burn, there are concerns about air quality and health risks from smoke. CBS News Chief Medical Correspondent Dr. John LaPook.
Close the doors, close the windows. If you have an air conditioner, set it so it's on recirculate, so you're not sucking in the air from the outside that may be full of dust.
Health concerns higher for older adults, children, people with breathing issues, and pregnant women. Confirmation hearings begin tomorrow for the incoming president's cabinet choices. CBS's Scott McFarlane is on Capitol Hill.
Republicans on Capitol Hill are racing to get President-elect Donald Trump's cabinet in place. Pete Hegseth, Trump's pick for defense secretary, will be among those first up with a hearing tomorrow. But senators are expected to grill Hegseth on his qualifications, as well as allegations of past alcohol abuse and sexual misconduct, which Hegseth has denied.
Negotiators in the Middle East report significant progress overnight on a ceasefire deal for Gaza. Israeli Foreign Minister Gideon Sa'ar.
Israel is working with our American friends in order to achieve a hostage deal. Soon we will know whether the other side wants the same thing.
A Los Angeles-based company that owns more than a dozen hospitals in 4 states has filed for bankruptcy. CBS's Matt Piper has the details.
In an initial filing seeking Chapter 11 protections, Prospect Medical Holdings, which owns facilities in California, Pennsylvania, Rhode Island, and Connecticut, listed debts of more than $400 million. Prospect Medical's bankruptcy comes less than a year after the bankruptcy of Steward Healthcare, another major hospital system once backed by private equity.
Dow is up 123 points in early trading. S&P down 33. NASDAQ off 237. This is CBS News.
Details ends 2-1.
An NFL star tucked into a good read on the sidelines of yesterday's game.
During the Eagles' win over the Packers, Philadelphia receiver A.J. Brown was seen on the sidelines reading a book, Inner Excellence, by Jim Murphy. He tried to explain later it wasn't a one-time thing. He often went to one of the passages in it.
Yes, I always revert back to like the beginning of the book. It states if you can just have a clear mind.
A clear mind, he says. Brown, who had just one reception for 10 yards in the game, says he often reads on the sidelines because football, he says, is 90% mental and 10% physical. For him, Inner Excellence is now the top bestseller on Amazon. Steve Kathan, CBS News.
Melania Trump says she's all set for round 2 at the White House.
I know where I will be going. I know the rooms where we will be living. I know the process.
Tells Fox she's already packed up and set to go. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
And happy Monday, everybody. This is Bloomberg Intelligence. I'm John Tucker, along with Emily Griffeo. Everybody who's supposed to be here today is not here, so we're filling in. Anyway, some serious headlines. Have you seen some of the pictures, the video coming out of Los Angeles? There are actually fire tornadoes. It's unbelievable. The death toll in the Los Angeles wildfires climbing to at least 24, with another round of bone-dry Santa Ana winds in the forecast this week. In just a moment, we're going to speak to Bloomberg meteorologist Rob Carolyn. He's going to try to give us an update. My question, Emily, is any relief in sight?
Right. When does it end? It doesn't look like it.
In the markets, traders scaling back bets on Federal Reserve interest rate cuts following Friday's blowout employment report, and the Treasury yields, they continue their march higher. How high can they go? And for the tech stocks, especially, Emily, they rely on expected future earnings, so those higher yields really having an impact. I'm John Tucker, along with Emily Griffeo, and again, we're in for Paul Sweeney and Alex Steele. But first, let's get a reset of the markets, and to do that for us this morning, good morning, Lisa Mateo.
Hey there, John. We'll have this Bloomberg Business Flash brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key political, economic, and climate indicators. Visit IBKR.com/forecast. Get started today. All right, so we've got the NASDAQ leading the losses this morning. It's down about 0.9%, 185 points. John was just talking about it. Tech shares really getting beat up. We have Tesla down about 1% right now. Palantir down more than 2.5%, and we have NVIDIA off off about 2.5%. Now, speaking of NVIDIA, chip stocks also taking a hit. This is after U.S. imposed caps on how many advanced AI chips can be exported to certain countries. So you have Intel down about 1%, and we have Broadcom just ticking up. It was lower this morning, but now it's up about 1.5%. Now, we talked about the NASDAQ. I want to go to the S&P 500. It's down about 0.3%, 22 points. We go to the Dow. That's where you're seeing a bit of a lift, up 0.4%, 194 points. We head over to the two-year yield, 4.39%, up 1 basis point. The yield on the 10-year, 4.77%, and that's up 1 basis point. Oil climbing to a 4-month high. We have Brent crude at $80 a barrel, WTI crude at $77 a barrel. The Bloomberg Dollar Spot Index, well, that's up about 0.1%. We have Bitcoin down lower, more than down 2.5% at around 91,000, and that has Bitcoin buyer MicroStrategy lower this morning, down about 2.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. I'm Lisa.
Thanks very much. Los Angeles and the rest of Southern California facing a second week of fierce winds that are turning those wildfires into blowtorches. Let's get the update, the weather forecast for Southern California. Rob Carolyn is the Bloomberg meteorologist. He joins us live right now. Rob, good to talk to you. If it weren't for the winds, would this even be a huge story as it is?
No, other than the fact it's been very, very dry this fall and early winter season, John, in Southern California. The LA Basin's had like 1/1600 of an inch of rain since October 1st, and this is their rainy season. So the winds have been the big problem. Last week we saw gusts to 80 and 100 miles an hour. Later today, we'll see gusts up over 40 miles an hour, and then tomorrow into Wednesday, it looks like the Santa Ana's ramp up, and we could be looking at gusts anywhere from 45 to 70 miles an hour, which really has the Weather Service there in Oxnard very concerned about the potential spread for more fires across Southern California.
Rob, Bloomberg News was reporting that as of early Monday, the Eden fire was 27% contained. The Palisades fire was 13% contained. That doesn't really sound like this is going to be over anytime soon, does it?
No, it's not. In fact, they made some headway this weekend because we had light winds and they actually turned on shore, Emily, and that actually brought some humidity in. I heard you guys talking before the break about when is it going to improve. There's no rain really in the forecast for Southern California, but it looks like once we get beyond Thursday, there's going to be a prolonged period of northwesterly winds off the Pacific that are going to push the marine layer inland, and I think that is going to be very, very helpful. The humidity will come up quite a bit by Friday, Saturday, and Sunday, and we'll also see the winds turn much lighter. The temperatures will turn cooler. All three of those things will be very helpful for the firefighters, but the bad news is today is only Monday, and we've got the next 72 hours to get through.
Here's a dumb East Coast question, Rob. What causes Santa Ana winds?
Okay, so John, what happens is high pressure builds in over the interior of the West in the fall and early winter months. We've had very cold weather in the central and eastern United States. Conversely, there's been a big high sitting over the West Coast. And what happens is the winds around the high pressure system go in a direction that Southern California ends up getting winds out of the east and northeast that they slow as they go up the eastern side of the mountains and then accelerate coming down to the western side of the mountains and canyons. And that it produces those Santa Ana winds. So the season is usually September through about January, early February. Once we start to get into February and March, you start to lose them. But we've had this persistent high over the West, which has really been keeping Southern California very, very dry and very mild. And conversely, it's been keeping all the rain to their north in the Pacific Northwest and across Northern California.
Rob, thanks very much. Appreciate it. Bloomberg meteorologist Rob Carolyn. Let's get a look under the hood of the markets right now. Vince Signorella, Bloomberg macro strategist, joining us. And Vince, I gotta go right to yields. What's behind the yield rise, and is it going to keep a lid on risk assets?
What's behind the yield rise is actually quite a few things. The primary reason is the anticipation of tariffs that might be coming and are expected to be coming once President-elect Trump gets a seat in the Oval Office. But, realistically, we're seeing a little bounce in some of the inflation figures. CPI sticky is bouncing higher. There's, a general feel. We saw the UMich numbers last week, the consumer expectations of what 1 and 5 year inflation are going to be really leapt higher. And so, inflation is a psychological figure. If consumers think inflation is going up, it will go up, and it's going to take yields higher, as well as the tariff situation. It looks like we're going to hit 5% on the 10-year by hook or crook, to be honest.
So what does that mean for the direction of stocks? Because there have been some times over the last few years where yields have been high, the 10-year has been over 5%, inflation has been a worry, and yet we've still seen the S&P 500 able to chug higher. Is it different this time?
Not necessarily. Higher yields in and of themselves don't undermine equity markets. They obviously undermine bond markets. But what you want to see in the U.S. is higher real yields. So if inflation is ticking up, you actually want to see the 10-year Treasury or the 2-year Treasury fall more so that the spread between the actual interest rate and the inflation rate remains either steady or actually higher in favor of real yields. So if consumers, or rather investors, see real yields in the U.S. steady to higher, the U.S. risk assets continue to be a good investment. So that's good for the dollar, good for equities, not good for bonds, of course. But that would at least put a floor under equity prices. Now, if it kind of changes where inflation outpaces interest rates and you see real yields decline, equity buyers are going to look for bigger returns to eat up what inflation is eating into their disposable income, and that's not good for equity prices.
Vince, always a pleasure. Appreciate it. Vince Signorello, Bloomberg,
and that wasn't a dumb
strategist. And well, I've got so many dumb questions, Vince, but thank you. Here's a headline for you, Emily. U.S. stocks on thin ice, ? That's a headline on Bloomberg in a piece from Simon White and Tatiana Darrier. And Tatiana joins us right now. You focus in part in this piece on stock valuations. Are they still, even with this sell-off that we've seen, are they still lofty?
Yes, absolutely. They are, historically speaking. I mean, we're still in bubble territory. If you look back, if you look at the most conventional measure of valuations, the PE on estimated earnings 12-month forward, or if you want to take the long-term view, the CAPE ratio of Robert Shiller's, using his methodology, that's basically taking 10 years worth of earnings. If you look at that ratio, that is also the highest since the 2000s bubble in the dot-com era. So basically, no matter how you slice and dice it, we're still expensive. And I think, that's the main issue. That is what has caused the sell-off. You see yields going higher, that basically degrades the valuation story, and then you see stocks sell off.
Okay, so what about excess liquidity? Because you write about that in your latest piece as well. And that seems like something that can continue to prop up stocks. So how do you kind of balance these different factors right now?
Yeah, I think sort of, the valuation story is there in the background. It comes to the fore when we see things like yields surge higher. But let's take a look, take a step back and look at the stock market. Right now, you have the fundamentals in place still, right? You have a good economy that's growing. We saw that with the jobs report on Friday. We saw it with ISM services and manufacturing also. And you have excess liquidity, which is a measure of growth in the money supply relative to the growth in the economy. So basically, that is all cash available to flow to risk assets. And as long as the economy is growing, earnings are growing, I think you will have deep buyers emerge pretty quickly.
Yeah, well, we were just talking to Vince and the focus on fixed incomes, treasuries there, especially as it pertains to stocks where you're paying for future earnings, i.e. tech stocks. That matters a lot, what we're seeing as far as rates go.
That matters. There is a psychological impact as far as we've seen the last time yields hit 5%. That was in late 2023. We've seen a stock correction then. But then, again, we take a step back and we'll look. So what is the impact on the economy of 5% yields? I don't think we have settled on a specific number on the yield that is causing issues for this economy. And I think it's more that the uncertainty. Is the Fed doing a mistake here? Will the Fed reverse course? What will the Fed do then? Maybe hike rates again? that is sort of, all weighing on stocks right now. But as far as the specific level, I think it's more sort of a psychological impact. Once the dust settles, we can go back to looking at the fundamentals and see an economy that has so far, pretty much been shielded from higher interest rates one way or another.
And just a parenthetical, I should note that Ed Yardeni of Yardeni Research, he's the guy who coined the phrase bond vigilantes in an interview with Bloomberg. He has said that the rise in rates is just a normalization of rates at this point.
Right, just going back to what rates looked like back in your day, John Tucker.
Well, back in my day, they were in the teens, so we don't want to go quite that far back. Okay. Tatiana Darrier, thanks very much. Appreciate it. U.S. stocks on thin ice. You're listening to Bloomberg Intelligence. I'm John Tucker, along with Emily Grafeo. We're in for Paul and Alex today. As we look at markets, the major averages, they are mixed right now. Lisa Mateo's coming up in just a moment with more. As far as the yields go, the 2-year, the 10-year, and the 30-year, they are inching higher today, but not quite at 5%.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Bloomberg Interactive Broker Studio. I'm Lisa Mateo. We've got red and green on the screen. The focus turns to inflation data and bank earnings this week. So today, it's the New York Fed's one-year inflation expectations. That comes out in about a half hour from now. Tomorrow, it's the Producer Price Index, and that's followed by December's Consumer Price Index on Wednesday. Now, bank earnings, they kick off Wednesday. JP Morgan Chase, Citigroup, Wells Fargo, BlackRock, and then Thursday, we move on to Morgan Stanley and Bank of America. This morning, NASDAQ leading the losses, down more than 1%, 232 points. S&P 500 down about 0.5% or 32 points. A lift to the Dow, it's up about 0.4%, 178 points. The two-year yield at 4.39%, up 1 basis point, and the yield on the 10-year 4.78%, that's up 2 basis points. The Bloomberg Dollar Spot Index reached its highest in more than 10 years. Right now, it's up about 0.1%. We have shares of Macy's lower, down more than 5.5%. It trimmed its sales outlook in the current quarter. Then you have Abercrombie & Fitch really taking a hit, down 17%. Raised fourth quarter sales outlook, better than expected holiday sales, but here's the thing, that just wasn't enough to reassure investors that it could keep up with that pace. Then you have shares of Lululemon. They were higher, now ticking lower, down about 0.3% after the company raised revenue and profit guidance for the fourth quarter. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That's a Bloomberg Business Flash. Emily and John.
All right, Lisa, thanks very much. As Lisa mentioned, the tech-heavy NASDAQ down another 1% in today's trading. So what's next? Let's put that question to Kim Forrest, founder and CIO of Boca Capital Partners. It's kind of safe to describe you as something of a tech geek, considering your background. What's on your bingo card right now?
Sure. Well, let's just make a mixed metaphor here. My bingo card, and I was a software engineer. I became a sell-side analyst that followed computer companies.
I didn't mean that as a pejorative, but, you know.
I know, no, nerd is like a good thing, man. I love it. Okay, but anyhow, just giving people background. And so I do look at tech, and tech, you know, it drove the market. Actually, one company really drove the market last year. I was looking at some statistics. Do you know that the S&P 500 is 15% NVIDIA? Holy cow, how'd that get to be there? Well, because NVIDIA grew, right? But is NVIDIA going to grow this year? Probably a little bit, but not like it did in 23 for sure, and maybe not as it did in 24. So, but should you throw out tech? I don't think so. I think there's a lot of smaller companies and probably companies that you don't think are in the bullseye of AI that you could take a look at. So that's what I'd do if you are a tech investor. But I'd also be very concerned about what's happening in bonds. And you don't expect a computer person or a software person to be concerned with that. But it really will affect the market if bond rates go higher from here.
Because the tech stocks in particular depend on future earnings, and yields are going to put an end to that party pretty quickly, I suppose.
Yes. I would love to be able to escape, you know, math and math modeling, but it really does limit earnings whenever, you know, rates go up. It is the thing that the 10-year is the number that everybody discounts forward cash flows at. So the higher that goes, the lower multiple that you can expect. Is it really that easy? Sadly, it is.
Okay, but, you know, I'm just trying to think about years where, you know, in the last maybe 2 years or so, there was a lot of talk about higher rates and how that was going to dent tech stocks. And it hasn't yet. I'm wondering if something has changed now that we're in what could be, I guess, good news for the economy means bad news for tech stocks because rates are higher. Because, you know, we were kind of saying that last year and it didn't actually play out that way.
Right. And I agree with you 100% that things change. And we should never, ever just accept like those old sayings of Wall Street, because every year is different. We have different investors. We have different companies. We have a different rate environment. There's so much going on. So at the basis, I agree with you on that. I believe if you would have taken out the Magnificent Seven, which are all growing, well, mostly, you know, we'll kick out Netflix and Apple. are mostly growing on AI, right? The theory that AI is going to drive these things higher in perpetuity. I think most of tech was down. And remember, tech spending used to equal business IT spending. So that's where the higher rates kind of come into play. It was businesses are not going to spend on IT, and because they're going to pull back and just not build for the future. So that's kind of one driver there. But I also think NVIDIA has had such an outweighed emphasis on the market, on tech and specifically for the last 2 years. If you go and look at their quarterly earnings and just look at the revenue, that tells you the entire reason why everybody has piled into NVIDIA and why it became, a less than $1 trillion company surely, and now the biggest company in the S&P 500, right? By market weighting and price. So it's been a completely outsized move because it had a completely outside move in its revenues.
Mm-hmm.
Okay, so what's AI spending going to look like from here on out?
Right. Well, you get a kind of a picture looking at Microsoft. They say they said they're going to spend $80 billion this fiscal year. I think it was J.P. Morgan did a quick assessment on how much Meta, Google, Amazon, and Microsoft has spent. It looks like Microsoft was on track to spend about $80 billion last year because they did it from January to August. And I just annualized, whatever the run rate was. So that brings us to $80 billion. Now, let's not sneeze at $80 billion. That's a lot of money. But it's going from $78 billion in 2024 to $80 billion. So I don't know that the big spenders in AI are going to increase like they did in the last couple of years, again, because they could, right? They were spending zero on it, and now they're spending a lot on it. But I don't know that they're going to double it again.
Kim, always a pleasure. Thanks for being here. Appreciate it. Kim Forrest, founder, CIO of Boca Capital Partners. You want to geek out?
Yes.
Really? Okay. Our
Time
next
to talk term premium.
Yeah, okay. Ira Jersey is Bloomberg Intelligence Chief U.S. Interest Rate Strategist, and he's joining us from our Princeton campus right now. Let me start off with this, because Mike McKee was in earlier, and he said, take note that the 2-year has risen above the Fed funds rate. Ira, do I care?
Well, what that means is that the market is getting ready for the Fed to do nothing, or maybe to raise interest rates after lowering it one or two more times. And I think that the market has, significantly adjusted to the economic environment being relatively strong, right? And Friday's data certainly suggests that the economy is not falling out of bed, and the rate market in particular has significantly repriced for that. Look, right now we're pricing for one interest rate cut, but it's sometime way down the road, like sometime in maybe the fourth quarter of this year. So it makes sense that 2-year yields are above the current Fed funds rate, but more importantly, it goes back to expectations and what the market's pricing for the Fed to do in the future.
So what would we actually need to see in the data for not just the 2-year to show maybe some expectations of a potential Fed hike, but for that to really be something that the Fed is considering, that is a hike as opposed to a cut?
Well, obviously, if we continue to have reasonably strong data, I think importantly, like Wednesday, we have the CPI report. So certainly rising inflation and inflation expectations would be something that the Fed would take very seriously, and the market might start to price. But let's look at the options market and what options on short-term interest rate futures are currently pricing. They're now pricing a 30% chance that the Fed will hike before the end of this year. So it's not zero, and it's already manifesting itself into market expectations. Now, remember, that was near zero when you go back just a couple of months ago, even back to October. Now, the fact that the market, there are people who are buying puts on rates thinking, hey, the Fed might actually start to hike, and because of that, we want to hedge that possibility. That's a massive sea change. So that is a market, something that I can point to in the market saying that people are worried that there's a real chance that the Fed hikes before year end. There is a political aspect of this, right? So we're talking about confirmation hearings for the Treasury Secretary and other members of the incoming Trump administration. And obviously, President Trump has already said he thinks interest rates are too high. Now, can he really exude a lot of influence on the Fed? Probably not as much as he would like. But there's going to be an interesting, at least a lot of headlines probably about what the White House wants and what the Federal Reserve ultimately may do. And that is the potential hike as the next move.
And it's important to note that it's not Arthur Burns who's sitting there as the head of the Federal Reserve right now. It's Jay Powell, and he's not going to be so malleable to the wishes of presumably his boss, Donald Trump.
Yeah, I think that's right, John. But remember, an important point that you just made, that Donald Trump is not going to be Jay Powell's boss, right? Jay Powell, in many respects, doesn't have a boss, right? He is first among equals on the Federal Reserve Board and then the Federal Open Market Committee. But the president, can't tell him what to do. The president can't fire him. Both the Attorney General back in 2018, when the last time we went through Donald Trump wanting to fire Powell, everyone determined that you can't do that for any of the reasons why the president wanted to, right? Just disagreeing on which direction policy should go is not a reason for the removal of a Fed chair by a president. So, I think that's going to be a very important, or it's going to generate a lot of headlines, but I don't think it's going to change policy very much.
Hey, I pointed to Ed Yardeni before. When he was interviewed here, he said, this is just a normalization of rates. In the minute left, do you agree with his assessment? I guess it's hard not to, agree with Ed Yardeni.
Well, I do think that when we say normalization of rates, I think we're seeing a normalization of the economy, right? And rates are just going to reflect what the current economic environment and the outlook for the economy is. We had a very unusual period from 2011 to 2018, and now we're kind of unwinding that and maybe going back to, it's hard to say what's normal, but let's say going back to a more 1990s, early 2000s type of economic environment, which means that in general, interest rates are going to be somewhat higher. Look, this isn't crazy high interest rates. It's only high relative to the last 15 years. It's not high relative to the forever history of interest rates.
And before you leave, Ira, 30-year, the long bond, 3 basis points high, 497. 10-year, 479. The 2, which I always say is more policy reactive, Emily, that is up about 2 basis points, 439. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, joining us there from our Princeton campus. You're listening to Bloomberg Intelligence. Emily Grafeo and John Tucker with you this Monday. We'll be right back.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Bloomberg Interactive Broker Studio. I'm Lisa Mateo. We've got stocks mixed, and this is as analysts rethink their Fed rate cut predictions this year after Friday's blockbuster jobs report. So we have NASDAQ down 1%, 204 points. The S&P 500 off by 0.4%, 26 points. The Dow, that's seeing a bit of a lift, up 0.4% or 201 points. We have the two-year yield at 4.39%, up 1 basis point. The yield on the 10-year, 4.78%, and that's up 2 basis points. I have to turn to commodities. We have Brent crude at $80 a barrel, WTI crude at $78 a barrel, and currencies, the Bloomberg Dollar Spot Index up 0.2%. We have the Japanese yen stronger, euro down 0.4% at 101.99 against the dollar. The British pound is weaker as well, and we have Bitcoin down nearly 2% at just over 92,000. Shares of Moderna, they're off this morning more than 21%. It cut its 2025 sales forecast, slow demand for its COVID and the RSV shots. And then shares of Howard Hughes, they're up about 9%. This is after Bill Ackman's Pershing Square Capital Management proposed a merger with the company at about $85 a share. And it looks like it's Merger Monday. Johnson & Johnson agreed to buy biopharmaceutical company Intra-Cellular Therapies for about $14.6 billion. Intra-Cellular higher this morning, up about 34%. And shares of U.S. Steel up 8%. This is after a report from CNBC that Cleveland-Cliffs is partnering with rival Nucor. It's in a potential bid for the company. Cleveland-Cliffs and Nucor, they're both up more than 3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That's a Bloomberg Business Flash. Emily and John.
All right, Lisa, thanks very much. Here are the latest headlines on the Bloomberg. The fierce winds expected to continue in Southern California, exacerbating wildfires and putting lives at risk. And the number of dead that we know about right now, it is up to 24, and that's expected to climb. Let's get the update on all this. Will Wade is the Bloomberg Energy and Climate Reporter here at Bloomberg. Will, put things into perspective for those of us on the East Coast. How much has burned?
A lot. I mean, a whole lot. We're up to about 40,000 acres. I know that sounds like kind of a random number. So here's some perspective. 40,000 acres is a little bit bigger than Staten Island.
Wow.
Wow. What do we know so far about the origins of these fires and how it started? And
you know what? We don't know a whole lot about that. I was just talking to my teammates. We cover utilities, so obviously we've seen in the past a lot of power lines get blamed for fires, and so often it's the case. PG&E went bankrupt a few years ago because they started a terrible fire. Today, we don't know. The utility in Southern California Edison, and they are looking at their power lines. There's no evidence now, but they've fielded some of these requests to retain evidence, so that's definitely where people are checking first.
We've heard a lot of blame being pointed at the mayor, at the governor. Is there any legitimacy to any of that at all, as far as you can tell?
As far as I can tell, it seems like a lot of politicization. I may turn out to be wrong on that, but for today, I'd say don't pay too much attention to that stuff.
So you're the energy and climate reporter. For us folks out here in New York, help us kind of understand the climate in California, not only the geography, but just the winds and the weather that they have that kind of propelled this fire and is causing it to spread so quickly.
Sure.
So
I mean, I know this really well. I grew up in California. The fall and winter months, the Santa Ana winds, they come every year. But what's happened in the past several years is, with climate change, we've got longer, hotter summers. We've had droughts. So you get these hillsides that are just baked dry all summer long, all fall long. There's nothing there but dry bush and trees, and it's fuel for fires. And then the winds come, and any tiny spark can trigger it, and the winds are going to just blow these blazes all over the place. That was the problem a week ago when there were like 90-mile-an-hour winds. They died down for a few days, but they started back up again now. It's supposed to last through Wednesday. Could be more after that. I think they're up to 70-mile-per-hour gusts coming this week. So it blows sparks, it fans the flames, it makes it harder to put them out.
What do we know in terms of the economic damage so far?
Oh, it's a big number. I just saw a number this morning. We're looking at $250 to $275 billion in damages. That's from damages, lost wages, supply chain disruptions, sort of the whole package. But that's a lot of money.
That would place this at, I mean, correct me if I'm wrong, it would be in terms of the cost, the worst natural disaster in history, in U.S. history, I suspect.
It could be. I haven't seen a ranking on that, but certainly it's going to be up there. This is a big fire, and we're not done yet. I mean, the two main fires are the Palisades fire and the Eaton fire. Palisades is about 14% contained. Eaton is about 30-something% contained.
What does that mean? Like 14% contained. Does that mean that it's likely to just continue to keep spreading? Like, what is the definition of contained fire?
You know what? I don't know exactly what it means, but it certainly means that they are not even close to under control yet. They're probably going to get bigger.
That's the economic toll, the damages. There's also a psychological aspect of it. You know people out there. You're from that area.
I do.
What's going through their minds?
Well, I'll tell you about my aunt, because I was texting with her yesterday. Her house is about 2.5 blocks from the front lines of the Eaton fire in North Pasadena. She evacuated a week ago, last Tuesday night. She was allowed to go home briefly to pick up some stuff over the weekend, but she is just really rattled. It looks like her house might be safe, at least from what I've been looking at today. It hasn't encroached on it anymore in the past several days, and I hope that stays true. But if she loses her house, it's going to be really serious for her.
And this is an area where it's just like you grow up, you live there, and then the landscape just like in a few days completely changes. That's got to have a tremendous impact on your psyche.
Oh, yeah. I mean, I know this area. I was there last summer. My mom texted me last week. She's like, remember that place we went for brunch last June when you were here? Yeah, it's gone.
Yeah. I've seen photos of some houses on blocks. They're the one house left standing, which in that sense, I guess you can feel lucky if that was your house. But then what happens? Then you move back into your house and all your neighbors are gone and then you're just on an empty block. I mean, that's devastating.
I would think that would really be hard to live there, just to look around at the community that you used to know and now it's gone. And it'll rebuild, but it'll be different.
What is your sense of what has to happen in terms of rebuilding and what happens in the future? I mean, can you really make your house and your property fireproof?
I mean, you can build it out of concrete, but the thing is, I've been writing about climate change for years, and it just gets worse. And more people talk about it now, but we still need to see behavioral changes. There are places that are no longer as safe as they used to be.
Well, I mean, behavioral changes in terms of what?
In terms of thinking, should I live here? Should I not live here? You know, there's a lot of coastal communities that are, you know, the local agencies are saying, we're not going to pay to keep rebuilding the roads when the oceans overturn it every summer. And you're going to have to think about how you want to live there.
Well, maybe, you know, we should all move to Vermont. Oh, but wait. Part of it was washed out because of the heavy rains. Maybe I should move to Florida, but I'm going to get hit with, you know, where do you go? What's safe now?
I wish I had a better answer for you. What I know is that climate change is real and it's a bigger threat than it ever was.
Do you get a lot of pushback when you say something like that?
Sometimes when I talk to my relatives in the South.
Yeah. Will, always a pleasure. Thanks. Will Wade, Bloomberg energy and climate reporter on the Los Angeles wildfires. And apparently at this point, no end in sight because the Santa Ana winds gonna kick up again. Bloomberg is now in your dashboard with Apple CarPlay and Android Auto. Want access to every Bloomberg podcast, live audio feeds, and headlines at the click of a button? Download the latest version of Bloomberg Business app right now. You are listening to Bloomberg Intelligence. I'm John Tucker, along with Emily Griffeo. A win for Alex Steele and Paul Sweeney. We'll have more in just a moment. Just ahead, Mike McKenzie, Bloomberg rates reporter, on the global bond tantrum.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
And I'm John Tucker, along with Emily Grafeo, your substitutes today for Alex and Paul. Hopefully you're welcome substitutes. Let's look at rates right now. As we said, the 2-year, the 10-year, the 30-year, all kind of flirting, well, the 30-year and the 10-year especially, flirting with 5%. A new regime for rates, normalization, what is it? Well, let's put these questions to Michael McKenzie. He's the Bloomberg rates reporter on the global bond tantrum. He writes, is wrenching and worrisome start to the new year. Well, what is it, a normalization of rates at this point?
Yes, that looks to be the case. We've got an economy that, as we saw on Friday, produced very strong jobs growth for December. We've got an inflation report coming this week on Wednesday, and that's expected to show that inflation remains sticky. And potentially you could get an upside on the inflation reading, which is only going to upset and alarm people in the bond market even more here at the moment.
So when you look at the rates market, what are bond investors saying about the future health of the U.S. and global economies?
Well, they're saying that the U.S. economy remains exceptionalism versus the rest of the world, and that you've got an incoming administration that wants to bring in tariffs, which could be potentially inflationary, but also wants to bring in tax cuts, which will help boost growth, but at the same time also increase debt issuance. And debt issuance is all running at, we're sort of having right now in the U.S. budget deficits we've only seen during wartime. So and the debt has climbed massively in the last decade. And on present projections, according to CBO, you're going to see the Treasury market go from 28 trillion to close to 50 trillion in the next 10 years if we stay on this current spending projection. So the bond market, obviously the front end of the curve, known as a 2-year, reacts to the economic data and expectations for the Fed. The back end of the curve, 10 years, 20 years, and 30 years, is far more sensitive to expectations for the long term for inflation and also for growth. So in a way, when we talk about normalization here in the bond market, the question is, are we going back to that sort of pre-2007 era where the 10-year was around 5%, give or take, and the economy was growing? But the big difference between pre-2007 today is the size of the federal deficit and the size of the actual outstanding amount of treasuries. And this is why a very geeky way of looking at it, known as a term premium, has been rising sharply in the last month. And it's been rising actually since the Fed began cutting back in September. So if you look at how yields have risen since mid-September, over a percentage point for the 10-year, a big chunk of that has been driven by this compensation that investors now require. They now want more compensation to actually buy and hold 10-year treasuries.
And we see that manifest itself in what, a bond auction?
You see it, there's a number of different models that measure this. The New York Fed has one, the San Francisco Fed has another one. They're all been rising. They're all telling you that investors are demanding more compensation to own treasuries. And in recent auctions, we have seen some weak bidding. That's definitely becoming a more noticeable trend.
What does this all mean for Wall Street then? Obviously, we have equity markets selling off, but I know you're not an equity guy. You're a rates guy. So what does it mean then for financial markets if we do see, the 10-year sit above 5%?
The way to look at this is if yields are rising because the economy is growing, then by extension, corporate profitability should be also expanding, and therefore, equity should be fine. There's probably going to be more of a rotation towards value and other sectors, but I think in general, if the economy is doing okay, and you've got a bit of inflation, that gives companies pricing power. Mm-hmm. And don't forget, profits are nominal. So inflation is going up, your profits are going to go up. So that's the good case. The worrying case is if you get a replay of what we saw in 1994, when the bond market decides it's time to tell Washington very bluntly, we're not happy with the spending. And that's why a lot of the focus will be on what does the Trump administration begin to bring in. Scott Bessent is having his confirmation hearing on Thursday. A lot of people in the bond market will pay attention to that because he's going to be the incoming Treasury Secretary. They have to come up with a range of tax increases, spending reductions to get the deficit under control. And if they don't do that, then I think the risk is you're going to get an unruly sell-off in the back end. It hasn't been unruly up to now, but there's always a potential that, as one of the persons I quoted in the story said, you could get a Liz Truss moment. You could get this bond market deciding this is unsustainable, and if that happens, the equity market is not going to like it, and neither is corporate credit.
Well, Liz Truss moment, we're talking about bond vigilantes. When do they enter the game? We only have about a minute left. And does Bessent have to have the conversation with Trump? Mr. President, we can't do this. We're going to have to raise taxes at some point.
I think you're looking at a scenario. We saw this in the 1980s when Ronald Reagan came in, right? He cut taxes. He increased defense spending. He also pushed through tax hikes because you can't keep going along this way. And the vigilantes became a growing presence in the 80s, and then famously in 94, they shot down the Clinton administration's proposed spending. So I think that's the story really looking ahead to 2025, the rest of 2025, is at what point does the bond market say no more?
I gotta wonder what Liz Truss thinks when we bring up her name.
The Liz Truss moment.
That poor
Don't
woman.
they say all press is good press?
Not in this case. Michael McKenzie, Bloomberg rates reporter. Thanks very much. We appreciate it. You've been listening to Bloomberg Intelligence. I'm John Tucker, along with Emily Griffeo. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM, Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM, Channel 121, presented by Oracle. Stay tuned for the latest market news, also industry research. The next hour of Bloomberg Intelligence with Emily Grafeo and Matt Miller starts right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Matt Miller here in the seat with Emily Grafeo, looking at some markets that are no longer down at session lows. We had the S&P 500 off almost 1% earlier after falling further on Friday, but now we're only looking at drops of about 0.5%. Yields are still up, right? 477. I'm not logged on my terminal net yet, not looking at my screens, but I'm guessing right around 477 on the 10-year.
478.
478. We were pushing up on 480 this morning. So that's the concern, right? Yields moved higher, jumped higher after we got that blowout jobs report on Friday. And that's what was a huge problem for stocks. Everybody repricing how many Fed cuts they expect in 2025. I think Bank of America said we could even be looking at a hike. And that erased completely the Trump bump in equities. The S&P 500 fell down to a lower level than it opened on November 6th.
And now we're down in negative territory year to date on the S&P.
Yeah, and all of the Mag 7 stocks are losers for the year with the exception of Meta. We'll continue to bring you this kind of data as we talk about what's going on in California as well. But right now I want to get over to Charlie Pellet with a look at markets. Charlie?
Hi, thank you very much, Matt and Emily. Here's what's going on. We've got the Dow higher right now, advancing by 162 points. That is a gain of 0.4%. S&P 500 index, though, lower, down now by 28. That is a decline of 0.5%. And the Dow Jones Industrial Average, I mentioned, higher. NASDAQ down 1.1%. Your 10-year, 4.78%, with a 2-year now 4.38%. Spot gold down $28 the ounce, a 1% drop now, $26.61. Bitcoin trading lower by 2.4%, and West Texas Intermediate crude back with a 78 handle now, 78.63. That is a gain of just about 2.7%. Well, moments ago we were talking with our Michael McKenzie about the outlook for 10-year Treasury yields. Kim Forrest is Chief Investment Officer at Bokeh Capital Partners. She says you cannot ignore the move in the 10-year.
The 10-year is the number that everybody discounts forward cash flows at. So the higher that goes, the lower multiple that you can expect. Is it really that easy? Sadly, it is.
Kim Forrest of Bokeh Capital Partners interviewed on Bloomberg Intelligence. Cleveland Cliffs partnering with rival Nucor in a potential bid for United States Steel. That according to CNBC, citing unidentified sources. Cleveland Cliffs shares, they're up by 3.9%. Nucor up 3.9%. U.S. Steel surging now by 8.3%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie, thanks very much. Charlie Pellet there with your Bloomberg Business Flash. Matt Miller here in the seat for Paul, I guess?
Paul Sweeney.
And Emily Grafeo in the seat for Alex. I didn't know if I was in the seat for Alex and you for Paul.
Well,
I didn't want to make that
This is
assumption
Paul's physical
just based
seat.
on our gender identities.
Right. This is where Paul sits.
True. We're looking at markets that have been disappointing this year, to say the least. We're down on the S&P year to date. We're down on the S&P election to date. And I saw a note over the weekend from BTIG that really kind of freaked me out, saying that we could see equity markets fall further. It made me think of Vince Signorella, Bloomberg's macro strategist, and I said, let's get him on this program to see what he has to say about it. Vince, it makes sense. I mean, you know, inflation expectations higher, the labor market tighter, rates higher. It makes sense that we would need to reprice stocks, doesn't it?
Absolutely. And actually, just a few moments ago, we got the New York Fed 1-year, 3-year, 5-year inflation expectations. And the 1-year inflation expectations kind of matches what we saw with UMich on Friday, which is this jump in the consumer inflation expectations for Friday. And the Fed's matching that. So I think, just as you say, when you look at higher prices and you look at the numbers we're going to have this week, we get CPI, PPI, and one that everyone seems to ignore, and I don't know why, which is the import price index, because it feeds directly into the consumer price index and what consumers expect prices to be. So I think that one comes out on Thursday. It follows CPI and PPI, but this week we get that slew of inflation information. If that matches what we've seen from consumer expectations and inflation is higher, we're done with Fed cutting rates this year, no matter what the projections are.
What about this idea then that, we don't need a Fed cut because the economy is resilient, GDP is
strong,
2.5%,
3%.
Wouldn't that be good for stocks? How do you balance, those two competing narratives, Vince?
I think what you need to do is get the market literally back on its feet again and take the Fed out of the picture. You really shouldn't be seeing the Fed do anything when, as you say, jobs are strong, the economies are strong. The Fed should not be part of the conversation. Yet, Fed presidents, Fed governors keep weighing in. We saw it last week with Goolsbee and such saying we're going to keep cutting, and I'm like, why? It doesn't make any sense whatsoever. Right now, you've got the 2-year yield banging up against the Fed target rate. Are you trying to tell me the Fed is going to cut interest rates through the 2-year and basically say to Treasury traders, I'm sorry, Treasuries are too low, you need to be buying them, and getting your yield to match where we think the 2-year or day-to-day spread should be? It's not going to happen.
Vince, I got a quick question about expectations for CapEx. We got a headline today from The Information saying that some of the biggest customers, Microsoft, Google, Amazon, are pulling back on orders for Blackwell chips. It all gets very technical and doesn't matter that much. But the point is, are we still going to see massive spending by corporations to try and get with AI? Because if it's $1 trillion or $2 trillion over the next 5 years, that enough is reason I could see for investing in stocks.
Yeah, I think it depends on earnings. If you have the earnings to support CapEx, you'll see that CapEx continue. Otherwise, you're going to see something about what we saw in the dot-com era, which was this massive spending, no returns, and then it took 3 to 5 years for those investments to catch up so that earnings came back. Just watch earnings. If the earnings stay stable, if not beating expectations, CapEx will continue.
Vince Signorello, macro strategist at Bloomberg. Thank you, as always, for your time. We're going to go next now to Rob Carolyn, Bloomberg meteorologist on everything LA wildfires. So, Rob, thanks for joining us once again. Just give us the latest update here on what we know about how contained the fires are and when this all starts to end.
Well, unfortunately, it's not until the end of the week or the upcoming weekend, Emily, that conditions are really going to improve once again. We went into a lull over the weekend where the winds became lighter. We started to turn them onshore, brought the humidity up, and correspondingly, we saw the firefighters start to contain both fires, the Palisade fire and the other large fire there in Southern California. And they've got some of the smaller fires completely contained. The bad news is there's an upper-level disturbance diving through California this morning. That's going to cause an increase in the winds today. Parts of the L.A. area are under wind advisory through 4 a.m. tomorrow morning. Then much of Ventura and Los Angeles County go under a high wind warning tomorrow at 4 a.m. that runs until noon on Wednesday. We're concerned in that time frame, starting at 4 a.m. tomorrow morning, about wind gusts of 45 to 70 miles an hour, which is going to cause some very significant problems. Once the upper-level disturbance gets out of the west, it looks like the winds diminish Wednesday afternoon. They become lighter Thursday and then turn onshore, which is much more helpful Friday, Saturday, and Sunday of next week.
Rob, thanks very much. Rob Carolyn, they're giving us the weather forecast, and it's so important here in ways that a lot of us are learning for the first time. I want to bring in Matthew Palazzola. He's the senior analyst at Bloomberg Intelligence for insurance. And Matt, this is one of the biggest disasters the U.S. has ever seen. In terms of total damages, we're looking at 250, some people are saying $275 billion. But in the insured universe, which is what you focus on, it could be only, and I say that, you know, in air quotes, $20 billion. Tell us the math behind that.
Yeah, so we're doing, we try to do a ground-up analysis on this. We are looking at the structures impacted. We're looking at property values. We're looking at historical events. So that's where we're coming up with a scenario analysis. A minimum of 10 is probably closer to 20. Matt, those numbers you talked about, those very high numbers, those are economic. Those come out. The earlier it comes out, the less I have confidence in it, to be totally honest. You will generally see the insured losses as a percentage of the economic. I think those numbers coming out now, they include stuff like lost wages, health insurance costs, not stuff that would come into my world, and probably a little high if I'm being totally honest.
Okay, so we look at, though, the market declines for a lot of these big insurers are pretty significant. What does that tell you, just when you look at, you know, what investors are saying about the outlook for insurers?
So generally, in a big cat event like this, you kind of see this reaction. I think we called it out in our note this morning, a bit of an overreaction in some of these names. We try to adjust for the market move, like the S&P was down over the past couple of days. Big insurance stocks were down more. We did the math on what it implies for the market cap. So a company like Chubb, it lost like $4 billion of market cap. They're not going to have $4 billion of losses in this event. So we think it's, you know, a bit of an overreaction for a lot of the names.
In terms of the costs, are we just looking at, you know, rebuilding structures that are lost, or are we looking at also lost revenue? Because we're not just talking about homes, right? We're talking about businesses as well.
So in the numbers, we don't have it explicitly in there, but insurance will definitely pay for a business interruption claim, or, you know, if you can't physically get into the business, that is part of business interruption. We're not focusing too much on that, to be honest. We're kind of more just looking at a top-down for the structures and, you know, what we might see per structure. But you will see insurance companies pay that. The limits, these are fair plan limits, that's the insurer of last resort in the state, are about $3 million for a house and $20 million for a business. So it could be low for some homes, maybe sufficient for some businesses. But you're seeing those kind of rough limits in the state.
Wait, let's talk about that for a second. So the FAIR plan, I imagine that's an acronym, FAIR for something, is the insurer of last result. So if I had purchased a house in the Palisades for $5 million, would I get FAIR plan insurance for the first 3 and then try and get Chubb to insure me for the additional 2? Or how does this work?
It wouldn't, not like that.
Okay.
So if you can't get Chubb to insure you for anything, then you'd go to the FAIR plan. So the FAIR plan, it's not an insurance company. It's kind of a pool, a residual pool. So meaning...
so this is when private insurers say, there's no way we're going to insure you there, you idiot. Your house is going to get flooded or it's going to burn down. The state says, wait, we want to insure that kind of risk. We want people to live in that area.
To some degree. So the FAIR plan was created by the state. It's technically not funded by the state. This has been a problem and, dare I say, a ticking time bomb for a while now. What happens is you are right, Matt, the state doesn't want people to not live in these areas, so they help create these mechanisms that can insure them too.
They want people to live in flood zones. They want people to live where wildfires.
I think they want to have, very nice, very expensive houses, and they don't want people to say, I can't live here because it's unaffordable.
Walk us through. I want to go back to like an example of a person whose house burned down, or maybe your family member's house burned down, and you have all of your possessions in that home. You put basically your whole net worth into that home. Now it's gone. How much do you get back? How much do you expect to get back, and how much money do you lose?
Sure. So, the answer is I can tell you all the mechanisms, but it will vary greatly. If you are in the FAIR plan, the coverage is pretty narrow. So you're going to get less coverage and to be honest, I don't know every detail about contents and things like that. If you had a traditional policy, you will insure it for your contents, you'll insure it for your rebuilding value. And that's kind of up to you and your agent. The insurance company will say there's a minimum that you need to insure this for. So if I have a $5 million house, they will assess, we think it's going to cost $4 million for you to rebuild this house, so you need $4 million of coverage. And at the end of the day, that will come back to if you have a mortgage, and then the bank is really pushing this because the bank has a big liability there. So you will have what you have, and that could be old. So it could be there's this thing called demand surge, meaning certainly in this event, there's going to be a surge on building products and demand for contractors. So that things could cost more. That doesn't mean you get that. You get what you are insured for. There is a product, Chubb actually sells a product where they guarantee it. So you'd actually pay more. So your premiums are whatever, $10,000 a year for a high-risk home, and you pay another $2,000 a year or whatever for the guaranteed replacement cost. So they'll say, okay, your home, whatever your home costs to rebuild, we'll pay. But that's the exception more than the rule. You had mentioned the contents of the home. You have contents. So you have your structure, and then you'll insure your contents. So if you've got, like Matt's got a bunch of Picassos in his house, right? Then you need to insure that for what you think it's worth, or you just don't get coverage for it.
So I wonder, when you're looking at these insurers, Allstate, Progressive, Chubb, have you seen, because of the back-to-back hurricanes that we had, or do you expect because of these wildfires that we're going to see some of them just go bust?
Go bust? No. The large national carriers, no. I mean, they're well capitalized. We may have said this in the note, but this will be an earnings event, not a capital. It will not need capital. Where you're on is smaller regional companies, and that's more so in Florida, that there's kind of specialists that stay in Florida, and those are these companies. They actually did okay during the hurricanes last year, but they're kind of this real bet on, is there going to be a big loss in the state or not? California has Mercury General, which is actually a sizable company, but is kind of California focused. They may have a big loss here, but even then they're not going to go bankrupt in that.
We don't have a ton of time left, but it looks like you're going to be watching the containment, right? Mm-hmm. And just the outcome.
Yeah, I mean, so there's a lot of uncertainty right now. Uncertainty in structures and what is a structure, how much each structure is worth. The containment is still low. The forecast, I didn't hear them, but I think the forecast is still pretty bad. So the winds are going to be pretty bad over the next 2 days.
Yeah.
What I've seen historically is, should you get good weather on your side, I feel like they can contain it rather quickly, but the longer it lingers on, the higher the losses are going to end up being.
All right, Matt, thanks so much for joining us. Matthew Palazzola there covers the insurers for Bloomberg Intelligence. We come back, we're going to talk about the drop in Bitcoin down to 91,600. This is Bloomberg.